Good morning, everyone. Thank you for joining us. We're going to kick off our program this morning with a short video.
Good morning, everyone, and thank you for that, Megan. That was some footage from our event in person last year, which we can hopefully all look forward to doing again next year. My name's Campbell Davis. I'm the chair of the Forum Committee, and on behalf of the rest of the Forum Planning Committee, the Real Estate Center, the International Advisory Board, I would like to welcome everyone to the 24th Annual Real Estate Forum. Despite a pretty major change in our venue and platform from prior years, the program this year will stay true to what we've all come to expect from this event as a showcase of the industry's thought leaders and an illustration of the Real Estate Center's importance to the university and the real estate community, both locally and beyond. Before we get started, a few housekeeping items that we do need to address. If you requested continuing education credits, you must have your camera on at all times. We are required by DORA to audit each session randomly to ensure that this is being done. If you didn't request education credits yet, you can still do so by emailing Lisa Peck at lisa.peck@colorado.edu. And you too must also agree to have your camera on at all times. And these instructions will also be put in the chat as well. After each formal session, a poll will be available for everyone to provide feedback, which we'll use for future planning. So we appreciate any feedback you guys are willing to provide. I would like to take a second to recognize our sponsors for today's program: the Bascom Group, Centennial Realty Advisors, Conscience Bay Company, DPC, East West Partners, Goldberg Properties, Coble and Company, Nichols Partnership, Otten Johnson, Robinson, Neff and Raganetti, W.W. Reynolds, and W.E. O'Neill Construction. So thank you to all of you. We could not do this without you. I'd also like to thank our community partners who helped us out by spreading the word about our event. Those include Crew Denver, Demcar, ULI, as well as our media partners, Colorado Real Estate Journal and Business Den. Now I'd like to welcome our first speaker, Chair of the International Advisory Board, Cindy Thomas. Even with her tireless contributions to the IAB and the Real Estate Center, Cindy still manages to moonlight as a managing director at RCL Co., where she provides advisory and portfolio management services to institutional and pension fund clients. So Cindy, the floor is yours.
Thank you, Campbell and Dave Haskell and the rest of the committee for your leadership in pulling this event together virtually today. The forum has been the flagship event for the CU Real Estate Center and our council for 24 years. And we welcome you all to a different but equally as impactful event this year. We appreciate your support and thank you for seeing the value in the programming, albeit virtually. So the CU Real Estate Council is the industry membership arm of this center, and our mission is really to prepare the world's next generation of real estate leaders through academic excellence, thought leadership, experiential learning, and lifelong career development. In Colorado, we're really friendly and we're fortunate to have such a friendly real estate community, and the council, our International Advisory Board, and really the center are integral parts of that openness and collegial mindset. The founders of our center set that in motion 24 years ago, and the next generation of leaders are guaranteeing that it continues into the future. So welcome, thank you for being here. I'm excited for the program to come, and I have the pleasure of introducing Travis Wenger, a member of the forum committee that helped put this together today.
Good morning. I'm Travis Wenger, and I'm a member of the University of Colorado Real Estate Forum Committee. We are privileged to have the Governor of Colorado, Jared Polis, with us today. Governor Polis is a proud Coloradan with a powerful background as an entrepreneur and in Congress. He is an advocate, supporter, and partner of Colorado real estate markets, and he understands the importance of real estate to our future. It is with great honor that I present to you Colorado native Governor Jared Polis.
In true virtual event fashion, it looks like Governor Polis is not quite here yet. So in the meantime, I would love if Mike Kirchwald would jump on and say a few words, just welcoming us this morning again and taking a few minutes to appreciate everyone's presence.
Thank you very much. I'm Mike Kirchwald. I'm the executive director of the CU Real Estate Center, and I'm honored to be the warm-up guy for one of our keynote speakers, Governor Jared Polis. But I want to extend my welcome to all of you for joining us today in this virtual format. The CU Real Estate Center, as our chairman Cindy Thomas mentioned, is almost 25 years old, and it actually was formed even earlier by a group of industry pioneers who realized there was a need for research and knowledge on this burgeoning real estate market in the state of Colorado and the Rocky Mountain region. And they formed the Colorado Real Estate Council. The council later became part of the business school at the University of Colorado, where the Real Estate Center was established. The Real Estate Center, we tell our students, it's a little bit like the real estate department, like a finance department or an accounting department, and the students see it in that fashion. But it goes well beyond that, because the CU Real Estate Center is a unique industry academic partnership between the real estate industry, not just in Colorado, but now internationally, and the academic side of the business school at the University of Colorado Boulder. We today have the largest real estate enrollment of students of any university in the United States when combining our undergraduate programs with our graduate programs. And our destination, we believe, is to be recognized as the #1 real estate program in the world. And that's not just because of our hard work on our staff, but it's actually due to the support of the industry and all of you. So your presence here today is critical. The center is funded by endowments and donations. It is not funded by tuition dollars. So we are independently funded. And this forum each year, as it has been for the last 24 years, is the single largest source of revenue for the center's support. So in so many ways, thank you for being here to share your knowledge, your expertise, and your experience with each other and with our students. But also thank you for sharing your treasure and your contribution to the Real Estate Center, which enables us to go forward. We're very proud of what we do and what we can do, and honored to be a part of the Colorado real estate community and the Colorado real estate industry. As a shameless plug, those of you who have not joined the Colorado Real Estate Council, the CU Real Estate Council, it is a membership organization. Is very affordable, but it plugs you into the industry, our networking, our large group of events. It gives you discounts on programs such as this annual forum, and it makes you part of a very, very important real estate industry association. So we welcome you, if you're not a member of the council, to join the Colorado Real Estate Council and truly be part of this family. So once again, thank you for joining us today. And we'll see if our governor has had a chance to break in yet. So, Megan?
I think he is a very timely individual, and we are slightly ahead of schedule here. So we're still waiting on Governor Polis, but we appreciate everyone's patience. As we all know, this virtual world is more challenging. We would love to see him walking through the door right now, but that's not the case. So if everyone doesn't mind just hanging on a few more minutes. I'm sure he will be joining us very shortly.
Thank you.
Some days I do. It's just
Thank you everyone so much for your patience this morning. At this time, I would love to reintroduce Travis to come back up and introduce our governor.
Thanks, Megan. Again, good morning. I am Travis Wenger. I'm a member of the University of Colorado Real Estate Forum Committee. We are privileged to have the Governor of Colorado, Jared Polis, with us today. Governor Polis is a proud Coloradan with a powerful background as an entrepreneur and in Congress. He is an advocate, supporter, and partner of Colorado real estate markets, and he understands the importance of real estate to our future. It is with great honor that I present to you Colorado native Governor Jared Polis.
Apparently we can't win with timing this morning. It looks like he just jumped off. So we'll wait one more minute. Thanks again, Travis. I appreciate you.
It's okay.
Hello.
Good morning, Governor Polis. Thank you so much for joining us.
But I had a little trouble getting on, sorry.
No, don't we love this virtual world that we're all living in today? Well, the floor is yours whenever you are ready. Thank you again so much for joining us today.
Thank you. And I know this is the 24 years of the CU Colorado Real Estate Annual Forum. I know we'll be back in person next year for the quarter century of the Real Estate Annual Forum. And this is also making history. It's the first year that this is being done virtually. And I want to thank members of the CU Real Estate Council and the Center for really being able to adapt to these times. And I want to thank Cindy Thomas and Michael Kercheval and Sharon Matusik and all of the sponsors that helped make this happen, as well as a terrific lineup of speakers. On behalf of the great state of Colorado, I want to thank you all for joining. And we are so proud to partner with market leaders that are here today to lay the foundation to build a real estate and housing market for all in Colorado. And I appreciate your time today. As you know, we are rapidly entering the final few months of the pandemic. We're grateful for that, with thanks to the triumph of modern science and not one, not two, but 3 safe and highly effective vaccines. We expect that everybody who wants to get vaccinated should be able to do so by Memorial Day, end of May, given our current supplies, which means immunity, of course, in late June for those who get it in the last week. I think we've seen, and it's highlighted, something that we've known all along, that housing stability is absolutely critical. It's critical. We've seen it with highlights during the pandemic, but it's also critical for our long-term success as a state. And even before the pandemic, during the pandemic, and until we have the will for change after the pandemic, there's far too many Coloradans that lack stable and affordable housing. And frankly, that is a detriment to not only their own health, but also to the health of our economy, as we need to have a workforce that can afford housing near where the jobs are. And in many ways, Colorado's the quality of life, our economic attractiveness really depend on our livability, environmental quality, and livability. One factor of that is affordability. There's other factors of livability that aren't in your direct control, like our wonderful weather and world-class recreational opportunities, but affordability is an absolutely critical one. In 2019, the state legislature started to work on a number of different areas of affordability with our Department of Local Affairs, including looking at how we can incentivize zoning for more affordable housing. But even with a dedicated funding stream, creating more livable housing and removing barriers to the development of more housing requires a lot more work. And that's why we're proposing a stimulus package based on community revitalization, innovative housing that can leverage state and private investment to make our communities more livable and help strengthen connections between Coloradans and the communities that we live in. We also are working to do Main Street revitalization and incorporate housing that includes sustainable development goals, adaptive reuse, transit-oriented development, creative art spaces, and outdoor spaces. Our work on affordable housing is more urgent than ever before, and we're so thankful for the public-private partnerships that are forming to dramatically increase the supply of affordable housing in Colorado. It's really a lot simpler than most people think. It's kind of right economics 101, demand and supply set prices. We're glad that demand is high. We have a great state and more people are finding out about it. But unless supply increases, prices go far, far up. We've also seen much more very interesting developments on the commercial side. We know that, and I'll use the state as a model, we have 31,000 employees. During the pandemic, 60-70% telecommuting. Before the pandemic, 1% telecommuting. Our new normal after the pandemic will be 20 to 30% telecommuting. We're going to reduce our footprint by over 1 million square feet for the state, mostly lease, some sales, And many companies are coming to the same conclusion that, of course, too much of a good thing is bad, meaning indefinite not being in person, productivity can suffer. But giving employees a day or two a week to work from home and telecommute, or having some employees telecommute and live in other parts of Colorado, absolutely can enhance productivity, employee morale, and retention. And so we would be very interested, and we are, in finding ways to convert commercial space to residential space and other uses, because we continue to have record high demand in residential, even as we expect commercial demand to continue to decrease as companies find new ways to operate leaner, more efficient, more telecommuting. And this work to prioritize affordability and bouncing back needs to continue beyond this recovery period. We're not going to address our entire affordable housing issue through stimulus. It's a start, but we really need the dedication to continue that work. And we know this last year has been challenging, but our grit, our perseverance, our innovative spirit have moved us all forward. In collaboration with the University of Colorado, Colorado's businesses are recognizing these challenges and really taking bold steps to make a difference. And today you'll hear from the Dean of CU's Business School, Dr. Sharon Matusik, who will announce a new scholarship fund launched by Colorado Real Estate Family, specifically designed to begin reimagining the landscape of the commercial real estate industry. How exciting. As a lifelong advocate of education, I'm particularly encouraged by the work that our universities and CU are doing to bring about this much needed change and really be a catalyst for positive change. As we're in the final stretches of the public health crisis, I look forward to continuing to work together to make sure Colorado comes back stronger than before, a place that's rife with opportunities to build and own a home, establish a brick and mortar business, raise a family, live a very high quality of life. We have a historic opportunity this legislative session to address our transportation and infrastructure needs as well, something that the commercial success of Colorado depends on, and that has been extremely elusive in years and decades past. And I look forward to working with the business community and legislators to get it done. Thank you all for your time. I really appreciate being able to address you today virtually. I hope we can address you in person tomorrow, and I'll turn it over to Dr. Matusik. Or perhaps Mike Kercheval.
Thank you, Governor. And thank you for following the script there. I appreciate that. Governor Polis, thank you so much for joining us this morning. Travis, thank you for the introduction. Governor Polis, just on behalf of the school and the industry, we want to say thank you for your support, and just a personal thank you from all of the staff and faculty at the university. We're now eligible to be vaccinated. We are anxious to get back in front of our students as soon as possible. And all of this is most sincerely appreciated. Ladies and gentlemen, I'm Mike Kercheval, Executive Director of the CU Real Estate Center at CU Lead School of Business. The CU Real Estate Center is one of the most important industry and academic collaboration centers in the United States. The center serves not only the Colorado real estate industry, but is an international leader in forward-looking real estate education, including areas such as our real estate technology initiative. Our center does not operate in a vacuum. While we still celebrate our independent roots as a pioneering real estate association of industry leaders, we are now an integral part of the University of Colorado Business School, the state's top business school. Our partnership with Leeds thrives because of enormous collaboration and support of the school's faculty, staff, and most importantly, its leadership. I'll tell you that for the last half a decade, Professor Sharon Matusik has played a leadership role in not only running the Leeds School of Business, but also in encouraging the Real Estate Center. In the last 4 years, Professor Matusik has served as our dean. Dean Matusik has guided and inspired a significant increase in the school's rise in prominence, including the growth of our real estate academic program, which has expanded from roughly 100 students just 5 years ago to over 500 students across our graduate and undergraduate real estate population today, making our program one of the world's largest real estate academic programs. Dean Matusik continues to embrace and champion our mission, and we are very pleased to have her at the helm. We are also very honored to have her today. Ladies and gentlemen, please welcome Dean Sharon Matusik.
Hi all, my own personal welcome to all of you. I'm thrilled that you're joining us here today. I'm also very pleased that I'm able to join you from our brand new building, the Rustandi building, which physically connects our School of Business to our School of Engineering, something that we're incredibly excited about because we think it represents the future of higher ed, the bringing together of that world of business and world of technology and breaking down those boundaries. So I'm very thrilled to be here with you today. Also, if Governor Polis is still on, I wanted to echo what Mike Kercheval said. All of us in higher ed are incredibly grateful that phase 1B4 will include higher ed educators because we are really looking forward to being back in person with our students. That said, I want to say that in terms of our real estate center, this is a really critical part of what we do at the Lead School. We're very proud of the great work that they do and how they engage all of you in the community in that work to serve our students and to serve our mission. And in many ways, what the real estate center and events like this illustrate is what differentiates the Lead School. So what I'm going to do next is I'm going to start sharing my screen. I wanted to give you a few highlights of things going on at the Lead School. And then I wanted to share some insights as we think about what the post-COVID world is going to look like and the impact that's going to have on higher ed. And then as Governor Polis foreshadowed, I have an exciting announcement that I'm going to share at the end. So with that said, I'm going to start sharing my screen. And take you through what makes Lead special. So what we think really differentiates the Lead School is our unique combination of academic excellence and access to our amazing business community. And again, all of you joining us today are a perfect testament to that. In terms of our world-class faculty, our faculty join us from the absolute best universities in the world: Harvard, Wharton, Stanford, Kellogg, London Business School, University of Chicago. And one great example from our real estate center is Tim McQuaid, Dr. Tim McQuaid, who just joined us this year. He's our research director for our real estate center. His PhD is from Harvard in the area of economics, and we are very happy to have lured him away from Stanford's Graduate School of Business. So that's the kind of talent that's in the classrooms with our students. Our faculty are incredibly productive in terms of rigorous academic research. We track things like per capita productivity in those very top rigorous journals. We're about 25 in that ranking. And then also what's really impressive about our faculty is not only are they making an impact on the academic side, but their research is commonly being cited in outlets like the Wall Street Journal, New York Times, The Economist, Washington Post, and the list goes on and on. What that means is they're doing work that has an impact far beyond the academic realm. And why do we care about that in terms of our educational mission? Well, one, we know that our students are getting the absolute best education they can, very cutting edge knowledge from people who are at the forefront of knowledge creation in their fields. But also, if you think about what academics do, what research is, it's solving problems that haven't been solved before. So that kind of a mindset and bringing that to our students, we feel is very important in terms of preparing them for the long-term success that they're going to have in their careers. We know that the skills they learn today are not necessarily going to be all the skills that they need to be successful 10, 20 years from now. So that mindset of looking at problems and figuring out answers to problems that have not been solved yet is a really important part of the educational experience. So we have truly stellar faculty. But it's that combined with access to our community that really makes the difference. It's that unique combination. We have built out relationships to bring all of your experiences into the classroom. And again, the Real Estate Center is a perfect illustration of this. We have extensive mentoring program. Our core curriculum includes live problem solving and cases where some of you are coming into our classroom, talking about what's going on in your particular company and charging our students with helping to figure out how to solve those issues. We also have a dedicated executive experience where we're bringing top business leaders and influencers into the classroom in all sorts of different ways. So it's that key partnership with our corporate and our entrepreneurial venture community that combines with that academic excellence to really shape the nature of a Lead School experience. We're also proud that we've got over 42,000 alumni in every state and in about 72 countries. So that also means as our students move forward, wherever they might go, there's a friendly buff to help them. So we're really proud of that connection to the community, and we see that integral in terms of how we prepare our students. And in terms of what that looks like, we have really great momentum as a result of that special combination. When we look at our undergraduate applications for this year, 35% increase year over year. We're also really proud to have the largest minor on our CU Boulder campus, which includes a real estate track. So that's something that we've added over the last couple of years and has been very popular. Means that that civil engineer or that environmental studies student can go deep in their area of expertise, but combine that with a business minor to make sure they have that kind of foundation to help them move forward. Also, the caliber and diversity of our incoming students increases each year, and we're also seeing terrific growth on the graduate program side. Across all of our graduate programs, we're seeing application increases of more than 40% year over year, something that we're very proud of. And as part of what we've learned from COVID, and I'll talk a little bit about this in a few minutes, is we've learned how to use technology effectively to complement the in-person experience with the flexibility that working professionals need. We're very excited to announce that we're launching a new Leeds Executive MBA for this fall that's going to combine technology and a high quality in-person experience for those in the business community who want to build out their skill set, get an MBA, but at the same time, continue to make progress in their careers. And our demand for real estate education has never been higher. So our MS in real estate program this current year has 37 students in it. We look to be on track to meet about that level this year. And that's a great increase. I'm looking at Mike Kirschval. I know he and the whole center have been working very hard on this. The year before, it was about 15 students. The years before that, it was in the 8 to 10 range. So there's been tremendous growth in terms of the demand for our MS and real estate program. And that's in no short part to the great work of our center and many of you who are joining us today. Also, it's exciting to see that our major in real estate at the undergrad level has 146 students with a primary emphasis in real estate, and then another 200 plus that have a secondary interest in real estate. So really tremendous testament to how valuable our students see the content knowledge that's delivered, as well as the connections to the community. They know that's going to position them very well for a successful career in real estate. All of this is in service to our mission. Our mission is to positively transform the future of business by inspiring and educating that next generation of leaders and creating impactful knowledge to shape the world. We have 3 initiatives that we're working on that are supporting this mission. And I'm going to talk very briefly about 2 of these and a little bit more about the third one. One initiative is called Career Impact. What we've done for this initiative is we've sat down with many of you, conducted a series of roundtables with business leaders and influencers locally and globally, and said, what does the future of business look like in your sector? What does it take to really lead long-term in that sector? And we've used those insights to update our curriculum. We rolled out a new updated version of our undergrad curriculum. Last year, we created a new MBA core. This year, we created a new core for our evening MBA students who are working professionals. And I mentioned we're rolling out the new executive MBA this coming fall. So tremendous progress in terms of making sure our curriculum combines the insights that we're learning from you, along with the great academic excellence from our faculty, to make sure we're delivering the right kind of skill sets so our students can be successful long-term. Our second major initiative is called End the Gap. We're very focused on making sure our female population is 50% across all of our different programs. So the way that we're doing this is trying to create more primary demand for business education among women. So when we started this initiative, our incoming freshman class was about 36% women. Fall 2020, we had 47.5% women, and we look to be on track for 50% women for the incoming fall of 2021 class. So that's been very exciting to us, because what we hear from many of you out in the community is that you would like to have more mixed gender leadership teams. You see that there's research indicating there's better financial performance, innovation performance, social performance, but you don't always feel like you have that pipeline. So our End the Gap initiative is aimed at making sure that we're attracting more students to the field of business generally, and real estate, of course, particularly, and that once they're here, they're well developed so that they can go out and be very successful in your organizations. And then our third major initiative is our partnership with the School of Engineering. I'm standing in our new Rustandi building. We're really excited about this. Our partnership with engineering takes three forms. One is the physical structure that I'm speaking to you from today. The other is how we're integrating our curriculum. And then the other is what we're doing with the student experience that brings together both engineers and business students so they learn from each other, build a very tight network and cohort that's going to help them as they go forward into the world. But the building itself, I have to say, one of the most frustrating things through this whole pandemic is we've worked incredibly hard on the design of the building, all the fundraising for the building, and we can't have an in-person opening. We've done a nice job doing a soft opening virtually for our students, faculty, and staff, but we really look forward to welcoming all of you to the building once it's safe to do so. It's a tremendous space. As I said, we are very proud of what it symbolizes, that coming together of the worlds of business and the worlds of engineering. Right in the center is an innovation and collaboration hub, lots of spaces to bring in the community so that you can work closely with our students and also learn from our faculty, and really terrific spaces. So we have the Coble Commons, which is the outdoor area that we've done a much better job of activating so that there's an indoor-outdoor living and learning community space here on campus. Also the Caruso Connector, which I'm speaking to you from right now. We've got some great technology. You can see the big screen behind me that allows us to use technology to elevate the student experience. So it's a really terrific space and a really terrific building. And again, we look forward to welcoming you to the building and also sharing more information about how we're partnering with engineering through our curriculum and through the experiences that we provide for our students. So a lot of great progress in terms of how we're moving forward. And what we are always thinking about is, what does this mean in terms of longer term and the future? I know many of you are probably doing the same sort of analyses that we're doing right now, and that is stepping back and doing a systematic assessment of, as we look towards a post-COVID world, what's going to fundamentally change? So in the process of doing this detailed stakeholder analysis, I wanted to share some early insights with you in terms of what the student experience is going to look like, and then also how we think that our engagement with the business community is going to evolve in a post-COVID world. So as we look to the student experience, what we know we're seeing now and into the future when we get beyond COVID is much greater cost pressures on universities. So with lots and lots of universities across the globe able to deliver content knowledge via technology, that means there's going to be a lot more downward pressure on the price that we can charge for higher ed. What does that mean though? The other side of that is students really want an in-person experience. They're very excited to get back to campus. They're very excited to interact with the faculty and the staff and the community. So that demand for a differentiated, very high quality experience as a complement to the content knowledge is what's going to be really important in terms of differentiating full service universities like ours. And that's a great opportunity for bringing all of you in and making sure we're able to integrate those experiences that you're having in a meaningful way as a complement to that content knowledge that we're delivering. So those high quality experiences that go beyond just the content knowledge are going to be incredibly important as we move into our post-COVID chapter. Also, we're learning that, boy, people like that extra flexibility that technology provides. I talked a little bit about our executive MBA a few minutes ago, but finding that right balance between using technology in a way that facilitates working professionals being able to move forward in their careers, but at the same time finding a way to create high quality in-person experiences, that balance is going to be really critical in the future. Our executive MBA format is designed to do just that. So it's a unique format in that students come together for a series of 3 residencies each academic year. So they're in residency for about a week, and then in between those sessions, they're using technology to learn and work together. So what that enables us to do is make sure that busy executives can continue to move forward with their responsibilities in their career, but at the same time build out that skill set. So that flexibility in terms of technology delivered content and in person is going to be increasingly important as we look towards our post-COVID chapter. And then again, building out the best of what we've learned. One of the great things about technology, and you see it in terms of the number of you who are on the at the conference with us today, it allows much broader access. So we're leveraging that in terms of bringing leaders from across the globe into our classroom and interacting with our students. We're also finding that technology provides additional complementary options in terms of supporting our students through advising, access to faculty, access to career advice, et cetera. So integrating the best of what we learned in terms of the access that technology can provide. And similarly on the research side, we found that using technology provides a lot of opportunities for more breadth of connection and quicker access to individuals across the globe who are doing complementary research. So those are all things that we're looking to build out and develop as we move past COVID into the next chapter. And then what does this mean in terms of community engagement and space considerations? So I mentioned a little bit that experience is going to become incredibly important as universities across the world can deliver low-cost content knowledge. So what that means is designing facilities and space to engage all of you even more in the campus learning experience. How do we make it easy for all of you to come to campus, participate in different activities with our students, or do that via technology? But that demand for facilities that help us engage the community in an increasingly comprehensive way is going to be incredibly important. More flexible work arrangements, this is nothing new. You heard Governor Polis talk about this as well. That's certainly going to shape how we use existing space. If we have people who are going to be working from home for some percentage of time, how do we think about that in terms of how we allocate space, offices, et cetera, to facilitate that? I also mentioned the greater cost pressures in higher education. That opens the door for more public-private partnerships in terms of building out our facilities, building out what we're doing on campus. So that, again, is another area that we looked forward to partnering with you in more detail on. And then also, people need to be able to access the right kinds of educational offerings throughout their career. So how do we think about campus and how we use our space in a way that accommodates not just the traditional full-time degree student, but also lifelong learners who might want to be on campus for short courses, for different ways of accessing knowledge, interacting with our faculty, participating with students who might be helping to solve some of the challenges that they're facing and learn from each other. So that's been something that we're thinking about in terms of over the long term, what does our space need to look like so that we can facilitate much tighter engagement with the community in terms of providing experiences for our students, but also providing lifelong learning opportunities for our community as well. So those are some of the things that we've been thinking about. And what you heard is one of the themes throughout my comments is about community engagement. And private philanthropy is incredibly helpful in terms of shaping our future. And so I'm very excited to make a special announcement. So in reference to what Governor Polis mentioned earlier, I'm very excited and honored to announce a scholarship fund designed specifically to begin changing the face of commercial real estate. The real estate industry, as you likely know, is one of the least diverse in the country, despite its size, reach, and economic importance. At its core, bringing more diversity is not only the right thing to do, but will dramatically improve the real estate industry as well. Mark and Mary, known as DIT, Goldberg, know firsthand the opportunities a career in real estate provides. With more than 40 years in development throughout the Rocky Mountain region, Mark's career in real estate is marked by many successful projects. When he reflects on his path, he highlights the importance of mentors who coached him and opened doors for him, like Walt Kobel and Gary Antonoff. Although neither DIT or Mark are graduates of CU, Mark's been involved with the Real Estate Center for decades, from mentoring students, hiring interns, serving on countless committees, and being generous donors. The Goldbergs' impact here at Leeds and CU is significant. Motivated by their personal experience in the industry, the Goldbergs are launching a scholarship and cohort experience, changing the face of real estate. The focus will be on encouraging and supporting underrepresented and female students in the real estate industry so that eventually the demographics of the industry reflect the world in which we live. Ultimately, the Goldbergs wish to help students pursue their professional paths and live a fulfilling and prosperous life thanks to a meaningful and rewarding career. Knowing the needs and opportunity far outweigh what they can do personally, Mark and Dit hope you will join them in making a gift to the Changing the Face of Real Estate initiative at CU. I'm incredibly grateful to Mark and Dit for their generosity and for the true impact they will have on our student lives for decades to come. Unfortunately, Mark and Dit are not able to join us today, but in lieu of their presence, I'm now going to stop sharing my screen and let Megan cue up a short video to celebrate this really great news. So I'm going to stop sharing. And turn it over to you, Megan.
Good morning, everyone. It's Mark and Dit Goldberg, and we really want to thank you for taking just a few minutes of your time, albeit on a video stream. We wish we were all together, and hopefully that will not be in the not too distant future. We have recently had the opportunity to get something started in the way of a new scholarship fund called the Changing the Face of Real Estate Scholarship Fund. You know, I have always felt that this wonderful industry that we're all involved in, the real estate industry, is really about, at its base source, community building. It's about making society better. We do it certainly through our efforts in real estate products, but that's really what we are doing. I think we are community builders. And it's been wonderful for me, and I know all of you, to be involved in this industry. But there's really been something sort of missing, and that is that the participants are all individuals that sort of look like me. And if we are to have a society that really represents all of us, then we have to change who participates in this industry. And if I think we do it properly, we can really change what has been a horrible part of our society, and that is systemic generational poverty. And there's no better way of making that change than through education. You know, for me, and I know many of you, doors were opened by family, opened by friends, or often opened by people that were in our industry that recognized something that all of us, that they helped us out and helped us become part of something that we probably wouldn't have been able to be a part of had they not reached out and reached out to us and opened those doors. And that's really what this scholarship is about. It is about reaching out to those people and members of our society that heretofore haven't had the opportunity to have those doors open for them. We're directly aiming at those people of color, people of different gender, different geographic locations before they came into the United States that are a part of our society. So I'm hoping that if we do this properly, that one day down the road that our industry will look like the demographics of our country, and that through that we will finally overcome systemic generational poverty. So I hope that you'll look at the Changing the Face of Real Estate Fund and join Dit and I and making something happen that really is long overdue. Thank you for your time today, and I hope you enjoy the rest of the program, and I'd love to talk to anybody that is interested in the scholarship fund. Thanks again.
Thank you, Mark and Dit. And Dean Matusik, thank you very much for your support, your leadership, your guidance, and we were thrilled that you were able to announce this scholarship fund today. I'm confident that this is a great first step in changing the face of the real estate industry. And you've been a champion of that, Dean Matusik, and so it is wonderful for us at the center in the industry to be able to partner with you and the business school and its initiatives to really make a difference, alleviating, as Mark and Dit said, systemic global poverty, and also improving our industry and improving society. So thank you. I also want to thank Mark and Dit Goldberg, who while they weren't speaking live, I know that they are on this call. And so I want to personally thank them for doing this. Thank you for making the video that you could share, because that's something that we can use to help inspire other people. And the message I heard from both of you was encourage other people to step up and join in contributing to this fund as we make a difference. And I cannot thank you enough for your support, and not just in making the contribution, but as Dean Matusik mentioned, you've been supporters of the real estate program and the business school for many, many years. And not being grads of the program, that I think even speaks more highly of your dedication and support of what we're doing. So thank you. And I also want to acknowledge your family members who are on this call as well. And we're thrilled about the legacy that is being created for you and by your family, and look forward to honoring that well into the future. I also want to take this opportunity to thank the folks who have put this program together. The Real Estate Center staff, Lisa Peck, Angela Gorbold, Katie Latier, and Megan Mahar, who's kind of been on loan to us the last few months to put this program together. So thank you to my staff, our staff, for doing this and pulling it together virtually. And I also want to thank the co-chairman and the committee of the program who've been working on this program for almost a year. And it started out in a very different venue and concept, and then we evolved to this high-tech version where we get to see each other's home offices and kind of how we live our lives on a daily basis. I also want to thank the firms of the committee members, because I know that you are allowing your employees to take time to do this for the benefit of the industry, for the benefit of the school, for the benefit of the program, and the benefit of our students. Appreciated Governor Polis's comments on several key initiatives and commentary, and I just want to queue up for us. Governor Polis mentioned affordable housing as being a major challenge to economic growth in the state of Colorado. And so in today's program, we have a marquee program looking at affordable and attainable housing, really driven by our research director, Professor Dr. Tim McQuaid, and his panel. And I look forward to hearing about that and what's happening there. Second, I was somewhat intrigued by, as perhaps all of you were, Governor Polis's comment about giving back office space. And our final session for today is really looking at, I would say, is office dead? And I think it'll be very interesting to hear from the premier office REIT and largest office REIT in the United States, their CEO and CFO, to hear what their perspective is on the office market and what it means, not just for the US, but specifically for markets like Denver, which rely very much on office workers and the office component of real estate. And then the two other programs bringing the economy together on a national level and at a state level, and what it means for the real estate industry and what the real estate industry means for the economies nationally and locally. So I want to give everyone an opportunity to take a quick break, to grab a cup of coffee, and we will be starting right back. And so let's take a quick break. And with my gratitude and thank you, please leave your screens on, and we'll see you back in just a minute. Thank you.
We hope everyone had a great minute to refill your coffee and stand up and stretch your legs. And at this time, I would love to introduce Campbell Davis to introduce our next speaker.
Thank you, Megan, and welcome back, everyone. Our next speaker is here to discuss the dramatic changes that our society and economies have experienced as a result of the pandemic, evolving labor trends, new U.S. administration, and much more, and what these mean for the future of real estate economy, both nationally and globally. So please welcome CBRE Chairman of Research and Senior Economic Advisor, Spencer Levy. Spencer, take it away.
Well, thank you, Campbell, and hello to my friends in Colorado. I'm going to start with a quick video, if I can make it work. Just gives you the entire world in 97 seconds, and then we're going to rock and roll. So, Brian, take it away. Okay, well, if we're not going to start with the video, let's give it a shot.
Spencer, unfortunately, I'm not seeing Brian on the call with us this morning.
Well, in that case, I'm going to take that 97 seconds back, and I'm going to start right here. First of all, I note that one of my dear friends and colleagues, Jack Durberg, is on the board of Colorado University. He wanted to be here today, but he had to speak to our board, so couldn't make it. But nevertheless, and I has two of his kids there too. So if there are anybody named Durberg on this call, hi from Dad. So let's talk about what's happening in the world of commercial real estate right now. And I'm going to talk about this in a macro sense, a micro sense, and then a secular sense. I'm going to speak for like 25 minutes, and then I want questions. Throw them into the chat room, please. And I will answer as many of them as I can. So the macro is this. The world is a lot better than it feels in your gut right now. And what do I mean by that? Because many people, certainly in California and New York, are still under strict lockdown. The disease is still not under control. So say, how can I say that? Well, I say this from an economic point of view. From an economic point of view, because of the massive amount of fiscal and monetary stimulus from the US and elsewhere, we are expecting a very, very good 2021. To quote the chief tax assessor of Chicago, Fritz Kagi, a friend of mine, he says that we're, quote, going to have the mother of all comebacks in the second half of 21. And based upon the numbers we're seeing, I would tend to agree with him from a macro perspective. And what does that look like numerically? Well, we think that US is going to grow around 5% this year and around 5% next year. And by the way, we're not the most bullish people out there. Goldman Sachs is closer to 6% because we see not only the federal support, that's number one. We see money in people's wallets as the average American. Now, granted, many Americans are hurting badly because of COVID. This is not to diminish that in any way, but the average American has more savings today than they did before. And we also have this thing called pent-up demand. And I'm going to give it the name that my buddy Henry Chin, my head of my Asia desk and research, calls it: revenge retail. People want to spend. And when I say people, I'm talking about everybody. And all of these things are going to come together for a very strong economic comeback at the end of 21 into 22. When I say at the end, we're beginning to see it now. We're beginning to see so-called green shoots showing up in the form of advanced transaction volume in commercial real estate in the fourth quarter. We're seeing consumer confidence strong. We're seeing business confidence improve. So the bottom line is things are getting better, but things are not going to get materially better until most people are back to quote unquote normal. And what normal looks like to you is freedom of movement in and around towns, but also for our industry in offices. Because now let me shift to where we are in commercial real estate. And so notwithstanding my macro optimism, micro, I'm optimistic, but not as optimistic. And I say not as optimistic because we are still, to use a very, very fancy economic term, kicking the can down the road to have real transaction volume, particularly on the leasing side in commercial real estate, particularly in multi-tenanted office in commercial real estate, which is really holding the market back. Now, are we seeing some increased market activity? You bet, but it's on the capital markets front, not as much on the leasing front. And that shows up in what I suggested before. In the fourth quarter, we had a reasonably good year. It was down about 19% year over year, but that's not bad. But it was almost entirely in three places. It was in industrial, it was in multifamily, And it was in these, what we call OPRI, or operational real estate, which includes cold storage, data centers, life sciences, single family rental. All of these little asset classes that used to be an afterthought are now getting big time institutional money. So I'm going to use a word now that I think you should be thinking about. The word is called distortion. And how has the market been distorted by the influx of federal money? Well, it's been distorted in certain good ways. Good way number one, we have not seen the rash of bankruptcies that we would have seen in the absence of federal support. So the fundamentals in office, industrial, are actually better than you think they are. The bottom line is that there were not a rash of bankruptcies because PPP loan, payroll protection plan, did their job. But what does the distortion look like from a capital market standpoint? The distortion looks like this. It looks like we just traded a $500 million pool of assets a few weeks ago in the from a large German bank. Most of that pool were hotels. Anybody want to guess what we traded it for? Because if we had traded that pool back in the global financial crisis, we would have gotten 50 cents on the dollar and patted ourselves on the back of being awesome. Well, maybe we're still patting ourselves on the back of being awesome, but nevertheless, we would have thought we were awesome at 50 cents then. Today, we got 97 cents on the dollar. That is a massive distortion in the market. It is a distortion because the fundamentals at most of these hotels did not justify that kind of pricing. But what did justify that kind of pricing was that these hotels had not gone bankrupt because of PPP loans. And so the distressed area where a lot of people are sitting down with catcher's mitts waiting for the sky to fall, they could be waiting forever because it may not happen. We see a new government support package happening now at around 1.9 trillion. We may see an infrastructure package to follow. So let me sum up the capital markets like this. Industrial, multifamily, it is the land of milk and honey. That is another fancy economics term. You got to kick the can down the road, land of milk and honey. But it's not all land of milk and honey because there are some forms of multifamily that are hurting. And those are the forms of multifamily that are in central business districts in places like San Francisco, like New York, like Seattle, like Boston, like Chicago. You know the places where it's hurting, and you know why. Because of the inability to move around, because of the inability to go to restaurants, to go to the office, to go to shows. And why are you going to pay $7,000 for a mediocre 2-bedroom apartment in San Fran when you can pay $1,700 for a full house in Austin, Texas? The bottom line is that these markets will not come back until freedom of movement comes back. And fortunately, because of the trajectory of the disease, we believe that's going to happen mid-year this year. It's already happening in some places. I certainly know it's controversial what the Texas governor just announced earlier this week about freedom of movement, but nevertheless, it's coming, and it's a good thing because we need it for our economy, but also we can do so safely. Now, let me talk fundamentally for a moment. Fundamentally, we are seeing tremendous demand in industrial for reasons that you understand because of e-commerce. And it's Colorado. So you guys like hockey there, right? That's like it's a hockey state. So let me use a hockey analogy. We talk about this thing called hockey stick growth. And that is what we saw in e-commerce in 2020. And the people that are paying record prices for industrial expect that hockey stick to continue, or at least to continue on a higher plane. What are we actually seeing now? By the way, this is my fancy chart here, folks. We are now actually seeing the hockey stick turn downward as people are getting back into more normal use. Now, will it be on a higher plane? You bet. But here is that word one more time. And if you folks are in the industrial business, this is your earmuffs moment, because there is another distortion in the market, and that is in the pricing of industrial. The pricing of industrial right now is priced at record levels, so much so that we just sold a $300 million portfolio in the Inland Empire in Southern California for, dare I say it, here it comes, folks, a 2 handle on it, a 2 cap rate. Yes, folks, 2 might be the new 3, 3 might be the new 4. And that distortion is caused by the massive amounts of government support, the massive amounts of equity, which, by the way, the amount of equity chasing deals in the United States today reached a new record level a month ago, even higher than it was post-COVID, but also because of the low interest rate environment. Now, Everybody on this call has probably noticed that the stock market's been a little wobbly over the last couple of days. And why is that? Well, it's because the 10-year Treasury has been spiking. The 10-year Treasury, which to me is the single most important financial indicator out there, is now up to about 1.4%, which is up 100 basis points from its low point in March, but it's also up 50 or 60 basis points since the election. And people say, uh-oh, here comes the other I word. The other I word is inflation. Well, the good news is the Fed announced on Monday that they may reinstitute what's known as Operation Twist. See, I'm not the only guy who uses these funny little terms out there to explain economics. Operation Twist is where they essentially buy long-term bonds and sell short-term to try to keep the yield curve relatively flat, to try to keep long-term rates down, because the Fed is concerned that they've lost control of the long end of the curve. Bottom line is the Fed never controlled the long end of the curve. The long end of the curve is controlled by the global bond markets. The Fed controls the short end of the curve, but the Fed's got a lot of money, so they can be a market mover simply by acting in the way they are. So long story short is this: we don't see the 10-year Treasury getting much beyond 1.7, 1.8% by the end of this year, 2 to 2.25% by the end of next year, and then topping out at around 2.5%. And a lot of the folks on this call, I know this is a university, so you've got some younger folks on this call, it's like 2.5%, that's really high interest rates. Folks, who here on this call, and we're all 29 years old on this call here today, by show of hands, who here had a home mortgage in the early 1980s? Anybody? Anyone want to admit it? All right, Lisa Peck, I'm going to ask you a question, Lisa Peck. You thought I wouldn't see your hand. I'm just going to put up a number. Was it above or below 10%?
Below.
Below. Okay, well, Lisa's a good negotiator, but it was probably above 7%.
Yes.
Okay, there we go. My point is this, folks. Even though interest rates are going up, this is not the late 1970s. This is not the early 1980s. And we all need Lisa to negotiate our mortgage, because that's a very good deal she got there in the early 1980s. So the point is, don't worry so much about it. And cap rates can still compress even in a rising interest rate environment. You say, well, that doesn't make any sense. Well, it does, because cap rates are not just a reflection of the cost of capital. They are a reflection of something that you need to really understand if you're going to understand the capital markets. It is the weight of that capital. And the weight and the amount of that capital is yet probably the biggest distortion in the commercial real estate business. Cap rates are going to continue to compress even in a rising interest rate environment. Now, people say, well, haven't you read our economics textbooks? That's not supposed to happen. Well, there have been points in history where you have seen an inversion, where you've seen an inversion between cap rates and the cost of debt, where you have what's known as negative leverage. The bottom line is this: we're going to be entering that period as there are some mega trends out there that are leading to this wall of capital. The biggest mega trend is an aging demographic. Too much cheap money, which I just talked about, too much cheap energy, too much cheap labor. And then, believe it or not, innovation itself is deflationary. What do I mean by that? You know, Mr. Fancy Guy here just bought his first electric car the other day, so it was pretty cool. But when I went and bought my first electric car the other day, the guy who sold it to me says, I said, well, when's the first scheduled maintenance? He says, oh yeah, a couple of years from now. I'm like, why? He's like, you don't need oil changes. There are very few moving parts here. I said, well, what about the mechanic back there? How are we going to pay that guy? He's like, well, they're not going to work as much. So innovation itself can be deflationary. And this is a change, folks, because yes, I'm going to get fancy on you again on economics one more time. There is a terrific book that came out 3 years ago by a guy by the name of Robert Gordon, won all kinds of awards. It was called The Rise and Fall of American Worker Productivity. Believe it or not, productivity of the average American worker on a percentage basis has been dropping since 1974. And you say, well, wasn't that the era of personal computers? Don't we have iPhones? Aren't we more productive than we once were? Well, from an economic perspective, we're not. And the reason is in part because innovation is deflationary. And we have these other megatrends that are pushing it down. Unless and until we see us getting more productive, and we see an increase in the US population through either a higher birth rate or, dare I say it, because I know it's a political issue, more immigration, we're not going to be more productive. And that's a problem. It's a problem because unless we're more productive, you can't pay workers more. And that's obviously a challenge from a macro standpoint. It plays into the $15 minimum wage and other issues. But let's go back now to commercial real estate. And let's talk about the one asset class that everybody here wants to talk about, which is office. And is anybody going to go back to the office? Well, I was just on the phone call just prior to this, which was why I was a minute late, with one of the largest office investors in the world. And we had to give them the bad news. Well, the current occupancy in New York City is about 5%. Current occupancy in San Francisco, about 5%. Current occupancy in Dallas, on the other hand, is close to 30 to 40%. Same thing in Nashville, same thing in Raleigh, same thing in Charlotte. Now, why is that? It's not just because of different laws. It's also because of freedom of movement. Freedom of movement, not dependency on mass transit. And freedom of movement isn't just getting you from your house to the office building. It's also elevator banks. Tall buildings take a while. As a matter of fact, a buddy of mine leases the Salesforce Tower in San Francisco. He said that in order to get everybody into Salesforce Tower under current San Francisco laws, you'd have a line out the door 2.5 miles long. It would take all day. And then by the time everybody was in, it'd be time to leave. So it's an impossibility of performance issue in places like that. But people say, oh yeah, the office is dead. Well, let me disabuse you of that notion. Because even though work from home is a big deal, and we do see that trend accelerating, I also want to let everybody know that I was an early 1980s music fan. And one of my favorite bands in the early 1980s was a band called Asia. And Asia had a song. It was called Heat of the Moment. And what was that song about? It was about in the heat of the moment, you make bad decisions. And where are we seeing those bad decisions? Or at least decisions that are going to change. We're seeing that in the surveys of large occupiers who are saying, we're never going back to the office, or we're going to full work from home, or CEOs announcing that. Why are they making the wrong decision? Well, number one, to use a legal term, since I am a lawyer by background, they are under duress. They are doing this under the pall of the pandemic. That's number one. Number two, many of them are speaking to, not to the real estate community, they're speaking to their own employees to make them feel safe and comfortable. So there's good reasons. And many of them are speaking to their stockholders. But what many of them have figured out, and many of them includes folks like Jamie Dimon, who came out with an announcement on this the other day, is that they're losing that magic word once again, productivity of their average worker by allowing them to work from home. And folks, you yet another fancy thing that we need to talk about here is the distinction between productivity and efficiency. This is my favorite debate, and I wish I had a whole hour on that. But the bottom line is that efficiency and productivity, where a lot of people conflate them as the same thing, they are not. Efficiency is cost consciousness, getting more out of less. Productivity is revenue generating, and it is unlimited upside. What does productivity look like? It looks like the attraction and retention of the best talent. It looks like collaborative work. It looks like creating the corporate culture that you want. It looks like learning the soft skills you need to be able to advance in your career and get promoted. Now, don't take my word for this, other than the fact that I've probably read more of these studies than just about anybody. There was a great study by Stanford University on this in 2015, and I could send it to you. Work from home can work from an efficiency standpoint. It does not work from a productivity standpoint. So yes, we are going to see people working in the office less. I was just on a phone call just prior to this with my global head of occupier. We think that the average employee is going to go to the office instead of 4.1 days per week, which is what it is today, maybe 3.3 days per week. But does that mean we're going to see a 25 or 30% drop in office demand? No, because we're going to see de-densification. We're also going to see diversification. We're going to see more hub and spoke models where people go into the suburbs a couple days a week to work, not just into the CBDs. We also are going to see a rise in more flex space. Now, flex space got a bad reputation during the crisis because of the WeWork challenges, but we believe there's going to be demand for more, a lot more flex space post-crisis than there was pre-crisis. Why? Well, even though I'm not a big fan of cost and efficiency, it is for that reason. Large employers typically lease 10 to 20% excess space for growth. They don't want to do that anymore. They want that 10 to 20% excess space to be in flex. And that flex space may be by a third-party operator like a WeWork. It may be done directly by the landlord, but we expect more of that. But there will be plenty of multi-tenanted office demand, even in these high density cities that are taking it on the chin right now. Why? I'll tell you why, because I just studied this. Because if you take a look at San Francisco, New York, two cities that are suffering more than most today, our studies show that yes, there may be a net outflow of people over the next few years because of the reasons you know, because of the cost of living, because of the lack of live, work, play, and other factors. But the most highly educated, highly productive people are still going to go to those markets. And because of that, those are the people that drive real estate demand. So look, folks, I'm not here to throw Denver under the bus. I'm a huge Denver fan, and I'm a huge Colorado fan because live, work, play is the future. It's actually now. I remember when I was a young professional, I was working in a small office in New York City. I was working from 7 a.m. to 11 p.m. at night, and I was like, man, this is the land of milk and honey. Now everybody wants to go skiing in the afternoons too. So, you know, things have changed since I was a young professional, but that is going to benefit markets like Denver, like Salt Lake City, like Raleigh, like Florida. By the way, Miami, Florida is the hottest market, not just heat wise, but the hottest real estate market in America right now because they're seeing a huge inflow of financial services firms. So the bottom line is this: San Francisco and New York, when people ask me what my number one investment idea is to back up the truck, using yet another fancy term, in those two markets, because they will come back based upon every study we've done. Now, let me talk about the other two asset classes, then I'm going to go to your questions. Retail and hotels. Well, look, you guys know most of the facts before I tell them to you. There are certain types of retail that are doing well, the grocery store and the pharmacy. And there are certain types that are not doing well, those places that are experience related, restaurants, gyms, movie theaters. And the tragedy, and tragedy is probably too strong a word, but the unfortunate fact is that we are not going to see a lot of these people come out of the crisis. We're going to see at least 20% of restaurants never come back. Certainly, they're going to be bankrupt coming out of the crisis. We're going to see at least 15% of gyms. And we're going to see a transformation of many of these movie theaters. How do I know this? Here comes the first of what I hope to be 3 or 4 shameless plugs of my podcast that I host. On my podcast, The Weekly Take, we hosted the other day Victor Coleman, the CEO of Hudson Pacific Properties. They are the largest owner of media properties in the world. They own them in LA, they own them in Vancouver, they own them all over the place. He said that we're seeing in these movie theaters, many of them are going to be converted into things like video gaming centers for competitions, things like that, stuff you'd never thought about before. But then again, nobody thought that a media company could be a REIT, and Victor proved it. So a lot of things you weren't thinking today are going to be change of use for many of these retail properties. One of them is in the movie theaters, but the others are going to be more live, work, play environments created either directly where people are building them from ground up or converting them. So by way of example, CBRE's offices just moved in Carlsbad, California, which is just north of San Diego, from a suburban office building to the second floor of a Westfield mall. Now, for those of you who are in the retail business, you know that the second floor of an open air mall ain't exactly the land of milk and honey for leasing activity. But our office space there is so nice. I almost moved my kid's bar mitzvah there. And if I didn't have a hire catering hall and it wasn't across the country, I probably would have done it. But the bottom line, that is what the future of retail looks like, creating these virtual live, work, play environments. And that's why the mall isn't dead when they create these types of environments around. What's the other types of retail we're going to see? We're going to see the so-called hybrid, or what, yes, here comes shameless plug number 2. Joey Agree on my podcast, the CEO of Agree Realty, a publicly traded REIT, said, are 4-wallers. What's a 4-waller? A 4-waller is a Best Buy, where you control all 4 walls. You have traditional retail in the front, you've got industrial in the back where you can distribute goods, and then they have a services offering around it. It's like a Lowe's, it's like a Home Depot. Those are the types of retail that will thrive moving forward. But don't throw under the bus New York City retail or San Francisco retail or Chicago retail. What they have right now is a capital markets problem. The capital markets problem they have is, putting this in very blunt terms, people paid too much for these assets 4 or 5 years ago, and they're not able to drop their rents to market levels, or they will lose the assets to the banks. So that is why you are seeing many, many vacancies in Manhattan, unless and until they're able to meet the market. But we still believe that demand will come back at once tourists come back and people will start walking the streets again. Last asset class I'm going to cover is hotels. And yes, hotels will come back, but they will be in 3 categories. There will be number 1, the international hotels, which are going to come back in about 2024. And the worst market in America is Honolulu. And they are going to really suffer because they depend entirely on international and obviously plane travel. And then business travel hotels won't come back in full till 2023, but many of them will not come back. So markets like New York City are going to lose up to 20,000 hotel rooms permanently. But those drive-to hotels, those staycation hotels, they're coming back. Tell you a quick story. My wife and I just celebrated our 21st wedding anniversary. And what do we do on our wedding anniversary? We take little trips. So last year, we went to Vancouver. Vancouver, Canada, if you haven't been there, that place is really, really nice. This year, we drove to Charlottesville, Virginia, because it was only 3 hours away. And by the way, Charlottesville's got a lot of nice little wineries, a lot of nice little restaurants. But the hotel we stayed at on Saturday night was booked. Why? Pent up demand, revenge retail. People want to spend and people will come back. And what people do I mean? I mean everybody on this call. And you know where you're going to come back to? Mike, this is what's going to get me thrown off this call, but I'm going to say it anyways. You folks are going to get back on cruise ships. You don't believe me? I'm going to prove it to you. Because remember, I am the research guy. And as the research guy, I did some research prior to today's call. And what was that research? I went to Carnival Cruise Line's website and I said, well, what's it going to cost me to take a 3-day cruise from Miami to the Bahamas when they reopen? Anybody want to guess the price? $139. The only thing better than cruising is cruising for free, folks. I was like, oh, I'm not getting back on that cruise ship. I was like, oh yeah? Well, let me prove it to you. And where did I learn this lesson? I learned this little nugget from the 1987 movie Wall Street, because they had a little tagline in that movie. Their tagline was, greed is good. Greed works. Well, I've got good news and bad news for you about that phrase, folks. The good news is that greed is not good. Greed is actually bad. It actually causes a lot of harm to a lot of people. So greed is bad. That's the good news. Here's the bad news. Greed actually does work. What it means is that people are motivated by value, by low prices, and it will change their behavior. And thank God for that, because 2/3 of the American economy is dependent upon consumer spending. The other 1/3 is the government and business combined. So we need that. And people are saying, oh, that's not me. I'm not motivated by that. Well, let me disabuse you of that notion. Because my good friends at the ICSC did a study last year, and they asked, why do Gen Zers, which is most of you, buy stuff in malls? Oh, you want to know why Gen Zers, which are people between the ages of 12 and 27, buy stuff in malls? Well, they asked them different categories. And you would say, well, we buy stuff in malls because they are environmentally sensitive. That was on the list. Because they're locally made. Those were on the list too. Those came in last. You know what came in first? Cost, value. Everybody's motivated by these factors. And that's why, to go back to what I said at the very beginning, we are going to see the mother of all comebacks in the second half of 21. And I believe, notwithstanding the timetables I gave you for the different forms of real estate, it will come back faster than I suggested a moment ago. All right, folks, it's time for Q&A. And I see a bunch of questions in here. Let's see here. First one says, looking great, Mr. Levy. Thank you very much. That was not a question, but it was in the chat room. Let's see. As a reminder, please submit. Don't forget. Here we go. What hotel types are best per Spencer? Drive-up convention style ones in urban markets? Not that category. The drive-to hotels in vacation locations are by far going to do the best. Also, those hotels that are at lower ends of the quality spectrum. So either resort type hotels where you can drive to them, or lower end of the quality spectrum. Because one of the things you have to realize about hotels is that many people, and I say this not disrespectfully, many people don't even consider hotels to be commercial real estate. They are an operating business. And let me tell you something, they eat a lot. If you have a 4-star property in a market like New York, Chicago, pick your market, costs you thousands of dollars per room per month just to keep the lights on. And that's why you saw so many of them shutter. But the hotels that will do well in the short term are the limited service and the drive-to resort style hotels. The fly-to and the business hotels will not come back to full capacity until 23 or 24. Next question, what is your concern with the asset bubble that is possible from the lower for longer policy in the US? Further, what are the positive effects that may come from foreign investors as the US dollar is weaker with this kind of policy? Okay, well, you should know that I'm not allowed to utter the B word, bubble. But no, yes, there are certainly asset bubbles being formed out there right now. And I'm not going to throw anything under the bus, but people are calling questions as to the value of the equity stock markets. People are calling into question the value of single family homes in hot markets like Florida. Now, I will tell you, as a personal aside on that last front, my father-in-law is a single family home developer. And I will tell you that in every prior recession, it was the wrong business to be in. Not this one. This one, being a single family home developer, has been the land of milk and honey. Never seen demand like this. Unbelievable. But is there a bubble in markets like Florida? And dare I say it, in certain places in Colorado where people are saying, I want your home. I have a good buddy of mine, Ann Sperling, who lives in Denver. And she said that people knock on her door to ask her to buy it. That's the kind of demand you're seeing in markets like Denver right now. So is there a B bubble there? Maybe. But the good news for Denver is there's tremendous long-term potential in not just Denver, but the broader Colorado markets because of its increasing strength of talent base, live, work, play, and otherwise. Second question having to do with foreign investors coming in. Is that a good thing? It really, really is a good thing because I used to have, when I used to be on the road, and by the way, when I say I was on the road, I was on the road. I used to do 200,000 miles a year. And when I evaluated markets, whether it was Warsaw, Poland, or Denver, or LA, I used the same 5 factors. And one of my 5 factors was the amount of foreign money coming into your market. So foreign money will increase post-COVID than it was before. And the reason is very straightforward. Number one, the US is a safe haven in any post-financial crisis because of our rule of law, because of our critical mass. But also this question, and it's Nicolina, thank you for your question, Nicolina, by the way, is pointing out yet another fact. It's cheaper to come to the US because of the cheaper US dollar and lower hedging costs related to the lower interest rates that we have in the US. Yes, interest rates have ticked up, but hedging costs today are less than half of what they were in late 2018 in the US. Next question, Trevor, would love to read this work from home study from Stanford. I will send it out to my good buddy Campbell after this and you can all have it. How about that? See that? Question for Spencer. Can you comment on potential conversion of office to multifamily? Thank you for your question, Kimberly. So, Kimberly, the answer is lots of potential, but in certain markets. It would have to be certain high density markets. So the places where you're going to see this conversion are in markets like San Francisco, New York, Chicago, Boston, but even in some older markets, you will see neighborhoods in markets like Milwaukee, like the 3rd Ward, the Arts District in LA, a formerly, not a commercial area, the Wynwood section of Miami, Fulton Market, Chicago, East Harbor and Baltimore. Folks, I travel the world. I can point out the neighborhoods where this type of conversion will happen. But the unfortunate thing here is, Kimberly, conversion sounds really good on a business plan until you try to pay for it. It's really expensive to convert to a multifamily use. That's why you're probably more likely to see conversions from old hotels to multifamily than you will see office, but you will see some office in these super high density areas. And one area that is Exhibit A is next time you visit Wall Street, that's my second reference to Wall Street in today's call, you look up. When you look up, when you're standing right in front of the New York Stock Exchange, you'll see all these old office buildings that have been converted. So yes, there's great potential for conversion in places like that, but otherwise it'll be slow because it's very, very expensive. And the trend that I just pointed out to you is these green fields in these markets like Wynwood section of Miami, Fulton Market in Chicago, the Meatpacking District in New York, I can go on for hours. It's sometimes easier to build new than it is to convert old, which is unfortunate because of the beauty of old buildings, among other factors. Okay, other question here. Peter Lindquist One very positive change of the COVID remote work environment is that it has forced high-bound managers, read old school, to accept the fact that people can be productive when not being visually monitored. That in the traditional working world has been the single business impediment to telecommuting outside of high tech. Can't get more high-bound than banking, but at least in our case, productivity has not declined at all, and all employee attitudes have remained largely positive. Peter, rock on, man. But I have to tell you that you have to look at it more broadly. I'm not suggesting to you for a moment that there aren't some companies, there are some schools where people are just as productive at home as they are from the office, but that is not the majority. The majority is productivity is higher, and it's not because the manager is staring down your neck, forcing you to, work harder. No, it's because there are positive benefits to collaboration that are not impossible to do at work from home, but much harder to do work from home. I had this conversation yesterday about what's going to be the future of work from home. Well, what we talked about was the equity in that. Do you treat people equally if they're at home versus in the office? So there's real issues here. And we said, well, what's eventually going to happen from a tech standpoint is that people are going to have probably holograms of themselves sitting right next to you. So they're physically there. You say, aha, we've solved it. I say, no, you haven't, because you haven't figured out what happens when that person goes out of the room and gets a cup of coffee. That's where a lot of the collaboration happens. These random touches. That's why the tech industry might be saying from one side of their mouth, people don't have to come back to the office anytime soon. On the other, they are leasing tremendous amounts of space because they realize that being in the office for most, not all, is more productive. But Peter, I'm happy to talk to you more about that offline. I'm certainly not disrespecting your particular situation. Next question from Trevor Walker. Walkable Cities by Jeff Speck compares walkability to the success of the city, but New York City has consistently had decreases in populations. What are your thoughts of the future of cities? Will CBDs hold out with condos and increased density, or do you think we'll see something more suburban, completely different in the future? I am very bullish on the future of cities, but I do like what you just said, like Mr. Speck said. I say it all the time, and now I'm stealing Mr. Speck's line here. I always said that the most important piece of infrastructure are your own 2 feet, the ability to walk from place A to place B in a live, work, play environment. This is the one and only one time I'm going to ever so slightly throw Denver under the bus. I'm just going to say it, but just take this into consideration. You ever notice why most people that live in Denver drive to the office? And I know this as a fact because I asked my own colleagues who live in Denver, why do you drive to the office if you live in Denver? Because there are height restrictions once you get out of the CBD that requires you to push multifamily further and further away from the city center because everybody wants a view of the mountains. Folks, I'm just going to be nice about this. You want to be green? Get more vertical density. Vertical density is the greenest thing you can do because the further out you go, the more cars you need to use, the more footprint you have in all kinds of negative ways. So the mountains are beautiful. Buy a picture. Allow more vertical density in Denver. Okay, next question. Ann Sperling. Ann's on the phone. One of my favorite people in the world. And by the way, my third shameless plug for my podcast. Ann was my guest. She was awesome a few weeks ago. Question for Spencer. With huge capital demand for huge new industrial supply, and so much percentage of total absorption from Amazon nationwide, do you see signs of imbalance in industrial fundamentals? Well, Ann, great question. We talked about this. The word that I use, and I'm going to use it right now, is distortion. Yes, there is a distortion in the market, certainly from a capital market standpoint, too much money chasing it. The question you're asking, is there a distortion from a fundamental standpoint? The short answer is I believe there is a little bit of a distortion, but not in all of industrial. Where I see the distortion isn't in these modern Amazon facilities like you're referencing, and it's when people are paying the same prices for 24-foot clear height versus the 35-foot clear height modern buildings. That's where the distortion shows up. The new buildings have tremendous demand, and deservedly so, and that will continue. There's going to be more demand for last mile. But when people start paying perfect industrial prices for less than perfect industrial, that's where the distortion shows up, because Amazon is unlikely to lease a 24-foot clear height older industrial building unless it's within the last mile zone of delivery. So great question, Ann, as always.
Spencer, just to interject real quick, we are getting short on time, so I think we have time for probably one more question. So if you want to pick the one that seems most interesting to you and let it rip.
Let me see what the best question is here. Well, all I got to say about the questions, though, is I often say before these things, when I do the university events, I judge the quality of the event by the engagement of the audience. And you were highly engaged here on these questions. So congratulations to you. I'll end on that note. I'm very bullish on the future of Colorado and Denver. Rock on, and thank you for the opportunity.
Thank you, Spencer.
Great. Thank you, Spencer, so much. Wonderful words of wisdom this morning. At this time, I would love to invite Richard Morgan to come up and introduce our next speaker.
Good morning. What a tremendous presentation by Spencer. It makes me break out in a cold sweat to have to follow Spencer, and just a wonderful presentation by him. And good morning. My name is Richard Morgan, Senior Vice President with Academy Bank, and it's my distinct pleasure to introduce Professor Timothy McQuaid. Professor McQuaid is an Associate Professor of Finance at the Leeds School of Business and its Research Director. He is new to the business school, and we're so pleased he's now a buff. The panel discussion today is on affordability and attainability in housing, and Professor McQuaid's core research interests are in real estate economics, household finance, and innovation. He is uniquely qualified to lead this discussion on the issues impacting affordability and the tools used by policymakers to combat this growing crisis. Now let me turn the podium over to Professor McQuaid. Take it away.
Well, thank you very much, Richard, for that very generous introduction. It's a real pleasure to have the opportunity to talk to everyone today about affordability and attainability. We have a great panel put together, so I'm really looking forward to this. So I'm just going to spend a few brief minutes setting the stage, and then I'm not going to take too much time. We're going to jump right into the very interesting panel discussion we're going to have. So the first thing to recognize is that the United States does indeed have an affordability problem. So according to data from the Joint Center for Housing Studies at Harvard University, in 2017, nearly 50% of households were moderately cost burdened in terms of their rents, which means that they were spending on the order of 30 to 50% of their income on rents. Now, if you actually look at the time series of this problem, it's actually gotten a little bit better on average since 2011. But that's actually somewhat misleading. If we consider the groups that we're most concerned about, low-income households, actually this problem has gotten worse. And with the fraction of households that are moderately cost burdened in terms of their housing expenses has actually been growing significantly since 2001. And indeed, for the lowest income households, on the order of 70 to 80% are now moderately to severely cost burdened in terms of their rental expenses. So you might ask, well, do we actually care about this? I mean, so why does it even matter if you're moderately to severely rent burdened? Well, we know data from the Consumer Expenditure Survey that this actually indeed does matter. So for example, households that have rent burdens and have children, these are households that are spending less on food, they're spending less on transportation, and most critically, they're spending less on their healthcare as well. So what's been driving this? Well, actually, there's been a number of dynamics that have been happening for decades. So one thing is that we've seen very significant divergence between renter incomes and renter expenses. So for example, between the years of 1960 and 2016, rental expenses on an inflation-adjusted basis have grown by approximately 50%, whereas inflation-adjusted incomes for households, renter households in particular, has essentially remained flat and stable. Now, to understand what's happening with rents, we of course have to understand something about supply and what's been going on with supply. Well, actually, if we look at supply and rental starts have actually been strong in recent years since 2006 and have been keeping pace with rental demand, keeping vacancy rates largely stable. But if you look at the low end of the market, the low rent stock has actually shrunk by 4 million units since 2011. such that in 2011, on an inflation adjusted basis, the number of units being rented for less than $800 constituted more than 60% of the total housing stock. Whereas in 2017, it was less than 45% and only slightly above 40%. So what we've been seeing is that whereas rental starts have been strong, those rental starts have been primarily concentrated in high-end housing and amenity-rich housing, and we have not been, and we've actually been seeing the overall supply of the low rent stock has actually been declining quite significantly. So now what I'd like to do is I'd like to actually take a moment to introduce the panel that we have today. So we have a very distinguished panel who's going to be helping us to think through these issues. So first we have Robin Kinich, who is one of 2 at-large Denver City Council members, first elected in 2011. Councilwoman Kinich has a law degree and more than 15 years of policy experience prior to being elected to council. By 2030, initiatives she has spearheaded will have invested approximately $750 million into housing and homelessness. And at the national level, the councilwoman serves on the local progress board, co-chairing the Housing Steering Committee. Next, we have Kimball Krangle, who is the Colorado Market President for Gorman and Company. Ms. Krangle is active in ULI, a founding member of All in Denver, a certified CCIM, and was recently co-chair of Blueprint Denver. Ms. Krangle was formerly senior developer for the Denver Housing Authority and is an expert on the revitalization and preservation of affordable and workforce housing. And finally, last but not least, we have Gene Myers. Gene Myers is owner and CEO of Thrive Home Builders, specializing in delivering green, energy efficient, and healthy production homes. Thrive has realized a number of market firsts: first to offer standard solar panels, first to construct all of its homes with Colorado beetle kill lumber, and first to offer a zero energy option on all single family homes. Gene was in fact the winner of the Professional Builder Magazine's 2017 Builder of the Year. So I think we have a really great panel put together, and the plan is we're going to spend about 45 to 50 minutes with the panel, and then we're going to have some time for Q&A at the end. So Robin, I think I'll start with you. So there are a number of policies currently in place to promote affordable housing development, yet given the data that I just showed, clearly significant affordability issues persist. How and why has the current policy regime failed to adequately address housing affordability, and what can policymakers do to further promote the development of affordable housing?
Thank you so much, Professor McQuaid, and thank you to all of the participants for being here today. I'm not going to leave this slide up for very long, but I wanted to give you a framework for how we think about affordability. And I'm just going to touch on each of these really quickly, what we're doing and why it's not enough. So building, preserving dedicated deed restricted affordable housing with price restrictions. This is the strategy we tend to think about when we think about affordable housing. And it works. We have built 2,700 new affordable homes since 2017 when we created our first new housing fund in Denver. And most of my comments will refer to the city of Denver, but hopefully some of the principles will apply broadly to those of you from other parts of Colorado. But as you can see, 2,700, right? Not quite keeping pace with the need. We have thousands more that are rent burdened, and we have other price pressures I'll describe. But we know that that method works, particularly when we keep the affordability long term. So this box is the most expensive box in terms of public funding. It requires public subsidy. And so we have an issue here with scale. So the method works, but we don't have enough public resources to get to the scale that's needed for the incomes that are struggling. We'll go ahead and I think take the box down just so we can talk more, but promoting stability to keep people in their homes. This is the most cost-effective box, right? Because this yellow box is really where we spend less to keep someone housed than we do to build a new unit. And you'll see that for the pandemic, this is where massive amounts of public resources are being spent on rental assistance. This is how we prevent homelessness, which is far more expensive to have someone be homeless and using emergency services than it is to keep them in their home. This is also a cash-intensive box, right? It requires a lot of public resource, but we also have public policies. If you think about rent stabilization or rent control, That's an example of a policy that does not necessarily require public resources. And that policy is not widely used in our country. It's in a few markets. It's not legal in the state of Colorado. So an example of where the only resources or the only strategies we really have for that yellow box right now are public dollars. And again, we cap out at how much we can afford. And then we don't have legal ability to do some of those other strategies. And I'm sure we could have a very vigorous debate about that policy. The blue box, expanding access to existing homes, right? This is a really also an efficiency box. Policy sometimes is at play here, like preventing discrimination by income source. So in Colorado, it is now illegal to turn someone away because they're paying for a portion of their rent with a voucher rather than just with cash. So that's a policy example that doesn't require public resources. Home ownership assistance, right? If you have the money to pay for a mortgage, but you can't get ahead enough for a down payment, that's an example where this blue box can help you get into a home. Public money is going into that strategy, but we also have some private and philanthropic efforts. So those are some of the strategies that can work. But again, you have to be able to afford the house. And so the blue box, what's the limit in the effectiveness of that strategy? Well, it's cost, it's price. You know, the rents that Professor McQuaid described, right, are not accessible. The sale prices of homes, not accessible. The red box, I left it for last because this is a real estate forum. And I know that there is a lot of interest in supply. I want to give you two reasons why supply is a piece of the answer, but it's not going to be complete. And Professor McQuaid, you actually did this better than most economists I hear in the industry. Housing is not a widget. It is a segmented market. So the person who buys a $3,000 a month rental or rents a $3,000 a month apartment is not competing with someone who buys a $600 a month income restricted apartment. They're different segments of the market. So there's two reasons why supply is not helping the renters that Professor McQuaid talked about. First and foremost, the rent burden is greatest for individuals who cannot afford to pay rents that a builder can build at market cost. So it would cost more to build the unit than the owner could get in rent for those who are most cost burdened. And those are folks earning below 30% of median income. Those are folks in the $25,000 to $35,000 a year range, depending on the size of their family. And then the second reason is that when we are talking about that supply, we don't have any price restrictions. So Professor McQuaid talked about the national loss. During the time, I just want to give you some numbers. Denver built 62,000 new apartments since 2000, 62,000 new apartments. That's a lot of supply. It was luxury priced, but guess what happened at the same time? We lost 28,000 apartments for those earning between $50,000 and $75,000 a year. We lost 28,000. So those are the reasons why supply alone will not solve this issue. I look forward to more detailed discussion about the different policies and so glad to be here. Thanks.
Thanks very much, Robin. So Kimball, just following up on that. So that's very much from the policymaker's perspective. Now, if you can kind of take from a developer's perspective, what do you see personally as the greatest financial, regulatory, construction, other factors that are currently standing in the way of affordable housing? And then following up on Robin's point about there being a segmented market and the types of housing that is being built, what recommendations do you have so that developers become more interested in building affordable or mixed income housing? Thank you very much.
Thank you. Can you hear me?
We can hear you.
Great. I was having some technical issues this morning, which was bad timing, but it's so great to be here. Thanks so much for having me today. This is an excellent panel, and it's great to see the other folks on the panel here today as well. So, you know, supply is definitely one of those issues, but as Councilwoman Kniech just said, you know, losing 28,000 units over that span of time of affordable housing, me as an affordable housing developer, when I'm doing a deal a year in Denver that's adding about 100 units per project, we're just flipped around on the equation. We cannot build our way back to a solution. And so what I would say is the greatest obstacles that get in the way of affordable housing stock that is high quality in neighborhoods of choice, and that will stand the test of time have to do with land constraints, and what the speaker before was talking about. You know, we're not willing to go up in density. And so we lose the efficiencies and economies of scale to create larger impact when we have that opportunity. It is also absolutely a limitation on resources. These apartment homes are capped on rents when we build affordable housing to make sure that they're right sized for the income levels that we're trying to accommodate. When you cap your rents, you inherently restrict your net operating income, which inherently restricts the debt service that you can carry on these properties. When you do that, you have, I mean, it's not like we're getting a break on lumber prices or steel or concrete just because we're building affordable housing. It still costs us the same amount of money. Therefore, we have to get subsidy to offset that funding gap, the sourcing gap. Unless we have adequate resources to do that, we just run out of runway. There's just not enough resource to do that. What recommendations do we have so that other developers become more interested in building affordable? I will tell you, I think that there are a lot of really great developers in this space. I love seeing folks like CU Denver, which is, you know, where I got my master's degree from in planning, be more attuned to the social payback that affordable housing has in our communities, as well as the economic development impacts and the absolute essential infrastructure that a spectrum of housing provides to our communities. We know that inherently, you know, 40 years ago, 50 years ago, we had different segments of the market that could accommodate different income classes. I think that there are regulatory barriers that get in the way of that, but understanding that we have the ability to make a difference in our communities by adding a spectrum of a housing affordability, that is attractive to, I think, a lot of folks entering into the workforce over the years. And I will say it's where I've spent my career. I love it. I wouldn't be any other type of developer. And I hope we attract more folks to enter into the market.
Thank you very much. So one thing that Kimball just mentioned, Jean, was that when you're building affordable housing, you know, the price of lumber and the cost still remain the same. So I thought it might be useful if you could speak to the current trends in the cost of producing affordable housing and what has been driving a lot of these rent increases. And then I know you've been focused in your company, particularly on innovative solutions. So how can you identify any innovative solutions on the horizon to produce affordable housing cost efficiently and at scale?
Well, thanks, Tim, and thanks, everybody. It's great to be here. Good to see Robin and Kimball. So I thought, you know, in talking about trends, I thought the first thing I would talk about is the supply and demand imbalance that we have in the state and in the Denver market. Because shortages are really what's driving a lot of the cost of delivering housing. So what does a supply-demand imbalance mean? It means there are more buyers out there than there are houses for sale. And what's driving that demand? Well, interest rates are driving the demand. There's also some element of a pandemic demand of people looking for safety and privacy. I walked into one of our sales offices the other day, and there was a young woman who was buying her first home. It was a townhome, and she just said, Mom and Dad said, I have to get out of that apartment. I need to be able to control my own space. So they're willing to come up with a down payment and co-sign on a loan. I think we all know on the call that we're in a K-shaped recovery, and as much distress as there is in the bottom of the K, if you're in the top of the K, you're probably well off enough to consider buying. And then this trend that Spencer mentioned about work from home, learning from home, it's driving a demand for more space. And so I think those are a lot of the demand drivers. In terms of supply, people just aren't putting their houses up for sale because of uncertainty about the future, and they're tending to delay selling in the resale market. Our statewide supply is down about 60% from where it was a year ago. Denver's even worse. I looked up a quote from the Denver Metro Area Realtors website that if no new houses were to come onto the market, Denver would be down to a 2-week supply of resale homes. It's especially bad for affordable home buyers. There's about a 1-week supply in the resale market right now in the $300,000 to $500,000 segment. Now, I suppose I should talk a little bit about, if you notice, there was a gear shift here. Robin and Kimball were talking about rental, and Tim set us up with rental. I've never built a rental affordable project. I'm a for sale home builder. And so that's where I'm coming from. And while there are tools out there in terms of tax credits and other tools for building rental housing for affordable housing, there's a distinct lack of tools for building for sale affordable housing. And so part of the reason for the shortage is a lack of those tools. There's also a shortage of building materials and an increase in costs. That slide was just up on lumber. We're up 125% on the price of lumber, and from where we were before the big crash last year. And just to put that in perspective, it's not like, oh, the price of one of our houses might go up a few $1,000s. We've had, we're building homes where the hit was $25,000 on the price of a home that has happened since the fall. And so the cost as well as a shortage, we've now been sort of tapped into the email traffic that some of our lumber yards and their buyers are having. And the buyers are telling us that it's completely unpredictable where this is going to go, because not only is it expensive, but they'll put in an order for 5 carloads and they'll get 2. So I expect that we'll get to allocations as well. Appliances, just about any product that we put in a home is definitely in a supply constraint. And why is that? Well, manufacturers shut down when the economy shut down a year ago. They didn't expect it to come back. They were slow to get back, and they can't keep up. And so I think we're just going to see this tremendous cost issue escalate. We're also facing a shortage of lots, like Kimball suggested. And then we also, believe it or not, in a period of high unemployment, we have a shortage of labor in the construction markets. Our cost of construction in 2020 was 9.4% higher than it was the year before. And you know, what could really be done about this? I think the immigration issue, Spencer mentioned that in the previous presentation. And so I think that's also an issue.
Like to jump in
if
if you
may be having internet issues.
Go ahead, Kimball. Would you like to jump in?
Sure. You know, one of the questions that Jean was just referring to was the innovative solutions on the horizon to produce more affordable housing. We've had to become very innovative in the for rent space, and Jean is absolutely on the front lines of innovation on the for sale side of housing. On the for rent side, we have had to look to create more mixed income communities on the same parcel of land that may have a tax credit housing development in addition to a workforce housing development. There are different financing mechanisms for each of that product type, but we essentially close on that financing at the same time. We come out of the ground at the same time. And we've been able to increase our impact to supply and increase the deal sizes that we're doing, still gaining efficiencies on the design, the entitlements, the construction, because we're doing more at one time. And that requires jurisdictions to think a little bit more creatively about how we address a spectrum of affordability in one location, which I think most of us here on this panel would agree is a really smart policy thought to have, and something that we'd all like to see built out. But it still does take some broader level thinking about how we mix parking ratios, or how we do free up extra jurisdictional support, such as reduced building permit fees or other impact fee reductions. But being able to provide, 30% of area median income up to 100% of area median income becomes a very powerful innovation to increasing supply while creating and delivering mixed-in housing, all in the same location.
Thanks very much, Kimball. Councilwoman, I think I'll turn back to you now. So there's been some discussion, increasingly so, a lot of people want a lot of the high productive jobs are in urban cores. So one issue that's been raised are land constraints and issues related to urban density. From a policy standpoint, how are you thinking about height restrictions and restrictions related to urban density and making more use of the land that we have available? And a follow-up question, how is transportation mobility related to affordable housing, and how should we be thinking that in a synergistic way?
Yeah, thanks for the question. So Denver has actually created significant zoning capacity in a citywide rezoning that happened in 2010, a lot of that near transit. It doesn't mean there isn't still more opportunity. I think the challenge for us has been how to ensure value capture. There was a study of the CUREC corridor, which is the South I-25 corridor, where the freeway expansion and the light rail went next to each other. Less than 2.5% of the housing in that area was affordable because we don't have a policy mechanism. The state of Colorado right now prohibits inclusionary housing. There is a bill to change that. But if we simply do the upzoning and we don't have a mechanism to require the affordability, then we know that we will not get true affordability for these moderate income households. And so I think the challenge is to tie the two together. What we learned in the 2010 rezoning is that 62,000 number I gave you, and less than 8% were affordable, most of those publicly subsidized. So we just know that we can't give away the density without the equity being tied to it. Now, hopefully the state legislation passes this year and we're able to have a little bit more flexibility. We have been able to negotiate some voluntary agreements for those density increases that are in large redevelopment areas where they need funding from the city. But I think that's the fundamental tension is it is not the case that we're seeing the affordability come from the upzoning. So there is capacity for some height. We're experimenting with it in two areas. 38th and Blake is a transit stop in Northeast Denver. The Central Platte Valley has a new area near the Elitch Gardens that is going to do a mixed use development that negotiated an affordable housing agreement. So I think where we have those agreements, then there is far more comfort with saying, okay, then when they choose the additional zoning, they'll do the affordability. We need to get the income levels for those units a little lower than they have been because of the income stagnation that you described, Professor McQuaid. And I think in terms of transit, the one piece I'll just add to this is I actually think that the federal government under the Obama administration was headed in a really good direction of thinking about what we call housing plus transportation cost, right? We in this panel and many panels talk just about that housing cost, but if you can think about the two together, what we know is that is an even bigger impact for families' affordability. And so they call it the H plus T. Now, what we are seeing from RTD, this is a journey I started before I was elected 10 years ago, and my policy that I worked on them with said, when you get rid of land, please consider it for affordability before you do other things. That was it. And that was the most we could win 12 years ago. Today, they're in the midst of passing a policy that will require 1/3 of the housing near transit to be affordable. And that's good for the transit system because it's guaranteed ridership, right? Ridership equals revenue. And so it equals sustainability of the system. And so by pairing that housing near transit, we should see a stronger transit system and better affordability for families. So I think that's a great policy that our transit agency is doing. And it's a great example of how to combine the two.
Great. So I think I'm going to turn to a question by Philip Brady, and I'm going to address this to the entire panel. This is actually something that I wanted to engage with you as well. So the question from Philip Brady is, how do you address the great affordable housing and inclusion goals at the city and state level with the public NIMBY backlash that often steers projects away from these goals? So to what extent do you believe NIMBYism is a problem in the affordable housing space? And if it is a problem, then what can we do about it? Kimball, I'll start with you.
This is a great question. Yes, NIMBY is a problem. Systemic racism is a problem. And oftentimes they come out in various dialogue from various stakeholders. It's our job as community leaders, as developers, as community members to be able to recognize that when it's happening, whether it's racism or classism, whatever that may be, that it's our job to be participating in an ecosystem at the community level that is inclusive. Without that, we know that community just does not work. I will say some places that have had a long history of NIMBYism have suddenly started to change their tune very dramatically. So for example, the mountain resort communities in Colorado, we do quite a bit of work in those communities, and the economic crisis has hit such an inflection point where without housing in place, these communities just cannot function. They cannot fill jobs and they cannot support the community that has come to exist there. And so we've had great luck developing affordable housing that is perpetually affordable in places like Vail and Keystone, Steamboat, and we're getting ready to break ground in Breckenridge on another project like that. These jurisdictions have come forward and said, we have to have housing and we have to have it now. Oh, and by the way, it needs to be net zero and highly energy efficient and sustainable in other ways, because they're just ahead of the curve on that. The crisis has just been very impactful. Broomfield is also another place that I would say up until recently, and Westminster would be the same. They thought that they had enough affordable housing that was naturally occurring. And then all of the sudden we've hit the last couple of years of great price increase. And you have these jurisdictions stepping forward and from a political will standpoint and a policy standpoint saying, we have to have affordable housing. Here are the metrics of the product type that we're going to support, and here's what we will do to open the doors and be inclusive of that. When you have jurisdictions stating that, it is a very strong message to communities, and then you have the political will when people do come out and showcase their NIMBYism. And sometimes those are uncomfortable conversations, but at the end of the day, our job is to be providing a spectrum of housing so that our communities can work.
You know, Tim.
Oh, go ahead, Gene. Yeah, go, please.
Sorry about the technical difficulties.
No worries.
You know, to Kimball's point about Westminster, we're working on a 58-unit townhome project in Westminster where they've donated the land and they're coming in and spending about $1 million to upgrade infrastructure to support this development. And so Kimball mentioned the gap. There's always a gap in affordable housing. How are you going to fill the gap? Cities can play a really big role, like Westminster, in addressing the gap to make affordable housing happen.
Can I chime in on this one too, Tim?
Please do, yes.
Yeah, so I will say that I don't think the key to responding to NIMBYism is to try to convince the loudest voices that they're wrong. I think the strategy that we've pursued in Denver is a couple things. One is, we see more NIMBY, frankly, to luxury high end than we do to moderate income affordable. So I will just say that that's not, the suburbs might have different experiences, but generally speaking, I don't see a lot of opposition to 50-60% of area median income housing. We do see deeper opposition to lower income housing. So I think the strategy is two things. One is to really include more voices. So challenging local government to frankly engage in the conversation with more renters, with more people of color, those that are not traditionally showing up at public meetings. When we add a more representative group of voices in our cities, we see a more representative group of opinions about affordable housing. I will just say too, this is really important for the industry. I have had many, and I'm not even going to name names, but I have had many situations where realtors, real estate developers, and professionals have been part of opposition campaigns to housing for people experiencing homelessness, or to other, types of special housing, like maybe a group home for someone who needs special care. The industry needs to really, really be self-reflective about how to walk the walk, not just in their own market rate projects, but across, and to be engaged with your neighbors with whom you might have things in common. You might be a homeowner, you might be Caucasian, you might be upper income. And if that's where the majority of pushback comes, then you have an obligation to think about how you can be attending your neighborhood meetings and how you can be a voice for these types of projects. Because the truth is that it's challenging for me when I hear those voices from the industry being part of that sentiment. So I want to be really clear that we need to hold our whole community accountable to that. And it's not just, we can't just pick and choose when we want to stand up to NIMBY sentiments. It's really, a proactive effort that I hope we can all think about how to be more inclusive.
Thanks very much. Jean, I'm going to turn to you very quickly, and then I think we'll come back to the policy side a little bit. But Jean, we have a nice question from Nicolina here that I also wanted to ask. So I'm going to just rephrase Nicolina's question a bit. So in addition to the affordability crisis, concerns over climate change have also spurred interest in construction of efficient and sustainable housing. So to what extent does increased focus on building sustainable housing complicate affordable housing development? Or do you believe that sustainable development is complementary to affordable housing and is a holistic approach possible?
It's really interesting that affordable housing developments often lead the market in terms of their energy efficiency and sustainability. But there is kind of a conflict, because it should come as no shock to anyone on the call that it costs more to build a better home. And so it makes that gap higher. And so you have to be more creative about how you can fill the gap. One of the things that I think helps a lot is if we can get, at least on the for sale side, if we can get a recognition of energy savings and credit that towards for the buyer towards qualifying for the loan and ultimately buying the home. A good example would be, we just wrapped up a 271 unit townhome development in Central Park in Denver. And the average savings of energy for those homes is about $100 a month. Had we been able to credit the customer with that extra $100 a month, it would have helped a lot more people qualify at a lower income level. And so I think the lesson here is that we need to get in sync with our cities. We need to be in sync with our climate action goals, with our sustainability goals, and with the benefits that accrue to the homeowner to allow them to then qualify. What I guess the quick way to describe this is, for every penny we have to charge more in monthly payment for a better house, we can save 2 pennies worth of energy. And so it gets better for the homeowner by being more energy efficient if the mortgage underwriters can take that into account in qualification.
Thanks very much, Jean. Kimball, would you like to I know you also mentioned sustainable housing. Would you like to offer your thoughts on sustainable housing?
Yeah, and I would agree with what Jean just said as well. We are, like I said, about to break ground on a net zero project in Breckenridge, and there is an added cost to that. But the town of Breckenridge has created minimum sustainability standards in their community. And so we've had to match that with innovation and getting very creative on the financing side. There on the for rent side can be things like energy tax credits that we can tap into. And I think on the larger scale, some commercial lenders are more willing to do what Jean was just referencing and allow us to show a reduced utility cost to increase the debt that we're carrying on the property. But I do think that there is a desire across the board for all of us to see a more in sync approach between the various policies that we have. I think, you know, if we can see sustainability, not just even as the sticks and bricks, but commute time, can you walk or bike to work, or the infrastructure to work remotely more than, you know, what we were doing a year ago even, that all contributes to sustainability as well. And so how can we locate housing? And one thing I wanted to mention as well about the NIMBYism is we have the opportunity in our cities, and specifically in Denver. Blueprint Denver created a great framework for saying, how do we add smaller amounts of density in our existing single family neighborhoods, whether it's through accessory dwelling units or added density within a single family home structure, group homes, as Councilwoman mentioned as well, that does offer a solution or another pathway for some affordability, and then that central location and more sustainability.
Very good. Thank you. I think we have a very interesting question from Kim Cohn that I'd actually like to pose to the councilwoman first. I think the entire meeting would benefit from this. So we've been discussing a lot about newly built affordable units. So one policy proposal that Kim puts forward is, wouldn't it be more cost effective to use public funds to purchase existing low cost or functionally obsolete units and make them solid affordable units? Why is the focus on new builds? As we've said, continued escalating costs is one of the real challenges for affordable housing, as Jean illustrated for us. So, Councilwoman, what about that? Why don't we purpose public funds for the actual purpose for purchasing existing structures and tasking them for affordable units?
Yes, well, I'll answer briefly and then Kimball should answer. But the short story is we do actually do what we call preservation, and that can be of an existing affordable building, or it can be a building that was quote unquote market rate, but just run down. And that's an example of a building that Kimball has done. And so, but, you know, I will just say a couple things. Our past speaker made a really good point, and I wanted to record him because I answer this about once a week, which is that it can often be more expensive to renovate than build. I know it's counterintuitive for us. It just feels like it would be cheaper, but because of asbestos and because of HVAC and all of the mechanical systems, I hear from my spouse does this work in her field, and she gets the same question all the time. It can often be more expensive to renovate than build new. And I hate to say it, but it's what we hear all the time. And then I will also say too that we are buying, like, for example, an old motel that was built on Colorado Boulevard has been converted to housing for those experiencing homelessness. They were fortunate enough that the cost did work out. And so we are looking at those opportunities, but often the environmental remediation and the HVAC situation is such that it just becomes very cost challenging. And then I don't know if I can punt to Kimball because she's done one of these and she can tell you the real lived experience.
Please, Kimball.
The councilwoman just basically said everything I would say. It's very expensive. And, you know, I think our affordable housing development community loves to jump in and take a challenge. And in the instance where we bought a property at 10th and Grant in central Denver, the Colburn Hotel, it was losing its affordability covenant and it was going to flip to market. And there were 92 existing households in that property that were all on vouchers, had been formerly homeless at one point in time, and were just about to be displaced. And we were able to work with the existing ownership who had an interest in maintaining affordability. They just couldn't see how to do it. We worked very closely with the city of Denver and our other funding partners like CHAFA to come up with a plan to preserve that housing, and we were able to do so. I will say we're looking at other possibilities of repeating that right now. There are some opportunities just given vacancy rates in some of the retail and office buildings throughout all of Colorado, that one of the questions on the table is, can this become housing? Hotels are another great example of that. Can we reposition these? There could be an opportunity for that. I think right now there's still a price adjustment that probably needs to occur, where people were saying, well, last year I was making this much in income on the property, and so I'm going to set my sales price accordingly. And the market's a little funny right now. You've got lenders and investors that are, a little squeamish in a traditional sense of development. And then you still have a ton of equity out there that's willing to come in and pay cash just to rest their dollars. And so sometimes the fundamentals of real estate just don't make sense. And that's something I think we're all combating in Denver metro area right now, is just that kind of out of market cash coming in looking for a place to sit, which is just driving some market wonkiness, is my term.
Great. Thanks very much, Kimball. Jean, I'm going to ask one more question about development, and then I want to spend a little bit of time on access, which, as the councilwoman mentioned, was the other part of the equation here. But one more point about development. Again, you've really been involved in innovation in this space. So what is your opinion on modular and panelized housing going forward as a possible solution to affordable housing and bringing down costs?
Well, it's really a hot topic in the home building industry. And by the way, it has been for my entire career, and you can judge from the color of my hair, it's been a while. I think there was a late, great national builder, Bill Pulte, who made a comment that the first year in the industry, modular was about to happen. And it was still the case when he stepped aside from Pulte some decades later. Why doesn't it work? And the issue that we've discovered as we've investigated panelization, we've investigated modular and just modular components, is it usually the component itself actually pencils, but you still have to bring your traditional trade base back in to complete the house. And when you do that, you get killed. So for example, if we were to do panelized exterior walls, we still need a framer to come in and do floors, roofs, and interior walls. And framers aren't used to doing that. They don't like doing it. And they're so busy right now, they don't have to do it. So we have to pay a premium for them to come back in. We're investigating right now a system that has the potential to completely displace subcontractors. And it's not that we want to displace our subcontractors, but we have to get to the point where we can use some of the efficiencies from building in a plant and actually get that down to the bottom line on housing. In this particular instance, we're investigating closed panels. So rather than just a lumber solution and a framing solution, it could also be an insulation and wiring and drywall solution. The way we like to say it is, not only does it affect the duration and cost of each one of those tasks, but you eliminate the gap in time between trades. I hate to admit it, but I think on a typical home that's being stick built, the longest duration item on a schedule is when nothing is happening at all. And so the ability to squeeze the time out of that is also really important. This particular option would also do modular for kitchen and bath cores, not for the entire house. But the industry is all over this. We've got to crack this labor nut on leaving dribs and drabs of each trade to require them to get back in. And then I think we can begin to see some cost-effective solutions there.
Thanks very much, Jean. Councilwoman, I'd like to return to you. So as we started discuss with this conversation, we said there's multiple facets of the policy response. Some is about supply, some is about actually understanding the segmented nature of the rental market and building in the right segment. But as you mentioned, it's also about access. So we actually have a question from here about rent control. So obviously rent control has been a pretty hot topic recently. There's been a number of recent ballot initiatives in California regarding rent control. I've actually had some of my own research on rent control. New York recently tightened their rent control restrictions. So how do you view rent control as a possible solution to the affordable crisis that we're currently facing? And do you believe it could be a viable solution for Denver or other high cost areas?
I think it's critical that we be able to have the conversation. And so the first step would be to, relieve the legal limitations. There's no bill on that this year. That's a conversation for another year. But I do think that being able to have the conversation, and I just want to clarify, there are really two very different policies that we could discuss. One is local rent control, which is based on a particular market. You might have a rent board that says, hey, you have a renovation you need to do, and we can afford to give you a little more rent increase to cover that. And it's a very particularized approach. The approach you saw in California and Oregon is more of a rent cap or rent stabilization, which is a statewide measure. Those conversations can include a lot of protections for things that the real estate community is concerned about, which is exempting recent new buildings so that you don't discourage, the production of new buildings. There's, 10, 15-year exemptions. There's a range of strategies that can be used to, address some of those market concerns. We still continue to see growth in markets that have rent control. So I don't want to catch anyone in the chat telling me that rent control will eliminate the building of new buildings, because we'll show you a bunch of places that still have new growth happening. Now, whether it's been changed or affected, yes, markets adjust. I will say land prices can moderate in places with these types of policies, and that's not necessarily a bad thing. Hearing our prior speaker and the speaker about people overpaying, right, for land and the bubble that can create. So some, obviously markets have ways of adjusting to changes in public policy, but I do think we should be able to have the conversation in Colorado, and it's unfortunate that that's prohibited right now, but I think we could really debate the local approach versus the statewide cap approach, and, pros and cons to each.
Kimball, again, access is really important when we talk about affordable housing. Now, from a developer's perspective, what is your take on rent control measures? And more broadly, how do you feel about inclusionary zoning? And what do you, from a developer's perspective, what do you think are particularly effective ways to improve access to housing?
As an affordable housing developer, and a lot of us wear a public hat as well as a private developer hat. I would say that, if you look at some of the markets that we are actively building in, we're essentially building to rent caps that are imposed via zoning. Whether it's at 80% area median income, 100% area median income. And we're doing this as a perpetually affordable requirement. We're putting use covenants on land to ensure that we don't lose this affordability over time. We figure it out, we make it work. Lenders get comfortable with it. There's absolutely a need. And I think as a development community, until we all can jump in together and say, there is not a one size fits all solution. We know we don't have enough resource for the need. We have to be able to address our supply of housing in different ways. It's not all going to fall under one bucket. That wouldn't be healthy either. But I agree, we have to have some consistency in affordability over time. We are not seeing incomes grow at the same rate that rent is growing, and that leaves a whole lot of people vulnerable. I think one of the reasons that the suburbs have started to back away from NIMBYism is because they're seeing this as more of a white collar problem now, and they're seeing that their kids or their friends no longer can afford, or their parents can no longer afford to stay in the communities that they've been in. And we're just seeing it play out as the cost of housing increases in Colorado, that we have to have multiple solutions to address the housing crisis. So I'm not against rent control. I think we will figure it out. I think we have to understand that there has to be subsidy to help us create that opportunity. We also want to make sure that we can maintain those properties over time. But if we have the political will and the partnerships, I think we can figure it out.
Thanks very much. Jean, I'm going to direct a question from Rebecca Bailey to you, because you are, as you said, you are primarily a developer of for sale homes. So Rebecca Bailey writes, much of the conversation is centered around affordable rent. I would love to hear more about strategies to make for sale homes more affordable, especially given that intergenerational wealth is largely tied to home ownership. So we've discussed a lot about rental housing. what do you see as the most promising strategies going forward, both from a developer side and from a policy standpoint, in terms of improving access to home ownership and lowering the costs in the single family space?
Well, as I alluded to before, there really isn't a uniform gap filler, so to speak, on for sale housing. And Kimball has just pounded this point home that it's a question of resources. And it's the same for sale. Where do you fill the gap? In the case of the Westminster project, that's free land. In the case of the work that we did in Central Park, the developer, Forest City, actually gave us land and gave us a subsidy for each unit that we built in order to deliver the units affordably. And so the challenge is always the gap, as I mentioned before, and getting creative about how to fill the gap is, I think, the answer. I guess I'd like to weigh in just a little bit as a card-carrying capitalist real estate developer to just say this. Affordable housing is a societal problem. It's everybody's problem. It's not the home builder's problem. It's not the rental developer's problem. This is a societal problem that is widespread. And when the solutions that we impose basically assess that levy of cost on one group, I think it's problematic. And I wish that we had the political will to, and by the way, it's way better than when I started. It's way better than when Robin started. When Robin started, or during her early years, we had inclusionary housing that pretty well rested a lot of the burden on the builder or the developer. The linkage fee is much more widely spread. It's paid for by all segments of real estate. And I wish we had the political will to just tax ourselves broadly to really bring huge resources to the table to solve the problem. So far, we haven't seen that. Now, we do have annually recurring revenue streams now in Denver, which did not exist when I started in all of this. And I would love to see a really effective statewide housing trust fund. But to me, there are a couple of ways to do this. One is just out of the general fund, because that's the most widely shared burden. But another one would be just a statewide property tax, because in an escalating property market, value market, who are the winners? The winners is everybody who owns real estate. And so if we had a very small statewide property tax to address this problem, I think we could do a lot of good things without overtaxing any particular segment of the economy, let alone the real estate economy.
Can I just tag on the 3 examples to what Jean just said? So thanks for the words. I think we have broadened the base of responsibility. I just want folks to understand what they are in Denver. In Denver, we have a local property tax. It's slightly less than $500,000 of property tax that goes to housing that is paid by all property owners. We recently passed a sales tax to fund housing for those experiencing homelessness that is paid by everyone who buys a good in Denver, including visitors. So visitors who have an impact on our economy are helping to mitigate some of the impacts. We also have a marijuana sales tax going into the housing fund. So, you know, we didn't just spread the linkage fee across. We also have 3 particular places where the general public is contributing to affordable housing, along with industry-based solutions that we're continuing to explore, like what the linkage fee should be in the future, whether we should have inclusionary. So I do think that Jean's point is really well taken, but I want folks to know that in Denver, we have stepped up, and the general taxpayers are putting as much or more into the pot than the development community at this point. So not that the development community is not part of the general public, you are, but the general broader tax base. So thank you for that point, Jean.
Thanks very much, Jean and Councilwoman Kimball. I'll just follow up with that with you as well. From the developer standpoint, we know that in affordable housing, there is government involvement through, for example, the low-income housing tax credits at the state level, opportunity zone programs were recently initiated. From your perspective, Do you think that we still need more support at the government level? We need more subsidy, given the positive externalities that we think affordable housing generate. So is there sufficient support there, or does the government need to do more?
You know, there's never enough resource. And if you were to have CHAFA on this call, Colorado Housing Finance Authority, they would talk about how for every 5 projects that are putting in for funding support, usually 1 is awarded. They are always oversubscribed on their funding requests, and we just don't have enough supply. I echo what Jean was saying and what Robin was saying. I mean, this cannot just be a one-size-fits-all solution. We have to find a variety of tools to be able to address the housing supply need. And it's, you know, it's not only just one bucket of affordable housing. There are different segments, as the councilwoman referenced earlier, that they're not widgets. We have to address along the spectrum. And so, yeah, we need more support. It's not likely to come down from the federal government. We've been very fortunate in the state of Colorado to be able to take in marijuana tax dollars and convert that into housing dollars. It's just never enough. Our need is just very, very high.
Thanks very much. All right, Kimball, there's one final question, and then I think we will need to conclude. And this is very quick. Kimball, are you referring to low-income housing tax credits alone with respect to CHAFA?
You know, CHAFA administers a low-income housing tax credit at the federal level, either 4% or 9%, and then the state affordable low-income housing tax credit, which we passed, what, 5, 6, I can't remember, 8 years ago now. But CHAFA also supports for sale product. They have a business lending platform that supports workforce housing. So CHAFA has a multitude of ways that they work to support varying types of housing.
Well, thank you very much. I would like to thank my panelists very much for a very rich and engaging discussion. I know I got a lot out of it. I hope everyone else got a lot out of it. It's been a real rewarding experience for me to be able to be involved, and I would just like to thank everyone very much. And I hope we clearly need to keep the conversation going, but I hope everyone got a lot out of this. So thank you very much, and I'll turn it back over to Mike.
I want to thank the panelists and thank you, Tim. This absolutely was amazing, and I think it not only exceeded everyone's expectations, but left us with a lot to think about and some of the challenges not only that we face, but the opportunities to make a difference by addressing some of these challenges. So while your panelists and you, Professor McQuaid, I know are extremely busy, we can't thank you enough for taking the time to join us today and to share your thoughts. So thank you for doing that. Taylor, I think you are up next.
Thank you again to all of our speakers today. My name is Taylor Welsh, and I am honored to introduce our next speaker, Brian Lewandowski, who is an expert on the Colorado economy, its demographics, and its businesses. Brian is the Executive Director of the Business Research Division at the Leeds School of Business, which has been a part of the university since 1915 and is known statewide for its Colorado Business Economic Outlook. Brian, the floor is all yours.
Brian, I think you're muted. Nope, not quite yet. Fortunately, not yet.
Now can you hear me?
There we go, Brian. We're in action.
Wonderful. Sorry about that. It has to happen to somebody in every one of these meetings. Okay. So thank you, Taylor, for that introduction. Also, thank you to our excellent Real Estate Center. Thank you, Mike, Lisa, Angela, Katie, for putting on another excellent Real Estate Forum this year, and really for all the work that you do for our real estate students day in, day out, and for our broader, the help to our broader real estate community. A year ago, when I was giving this talk to you, who knew that we were really standing on the precipice of such a global disaster? Just to give you some perspective, at this point last year, there were a total of about 81,000 global COVID cases. There were only about 3,000 deaths globally. And most of that activity was recorded in China. For reference, the US only had about 30 cases. We had fewer than 10 deaths. And it was a year ago tomorrow that Colorado recorded its first COVID-19 case. The following week, school districts started to shut down in Colorado. I believe it was May 15th that the ski industry started to shut down. It was May 25th when the stay-at-home order went into effect. And now fast forward to today, we're looking at 115 million global COVID cases, 2.6 million global COVID deaths. And domestically, here in the US, we have over 28 million COVID cases. We've had over 500,000 COVID deaths. So the impact has been pervasive. I think you'd be hard pressed to find someone who has not been affected. Anything from wearing masks and working at home, teaching your kids at home, missing weddings, missing funerals, experiencing unemployment or furlough days, suffering illness, or experiencing loss of your own. But many of us have also taken on new hobbies. There is a shortage of bikes nationally as people were rushing to get outside and do something different. We saw a shortage of camping equipment. And perhaps even some of you took to putting together puzzles. So this was an activity that we did as a family over President's Day weekend. This was a typical 1,000-piece puzzle. I'm not a huge puzzle person. These start off sort of tediously slow, and then there's sort of these spurts where we put together a couple of the geese, got the house put together. So there's kind of these little successes along the way. But if any of you have done this lately, there's this period near the end where you start to gain a lot of momentum and a lot of pieces are coming together really quickly. And we got to the end of this puzzle, and I'm not making this up. We were one piece short. We had somehow lost 1 out of 1,000 puzzle pieces. And I think there's a lot of parallels here to how we're looking at this economic recovery that we're in. There's been a lot of fits and starts with the recovery that coincide with the rise and fall and re-rise of COVID cases, with the government mandated shutdowns of some of our industries like restaurants and bars out of keeping people safe, out of the effort for public safety. But then there's also been sort of this, I heard it said in the last presentation, this K-shaped recovery, where some people are looking at it like, what recession? And other people are really struggling. So we're sort of a few pieces short of having a real economic recovery. And that's what I'm going to talk about a little bit today. So I want to frame this a little bit by looking at what's happened nationally in terms of the economy, and then we're going to zoom into Colorado and a little bit about the Denver metro region. Nationally, U.S. real GDP took a small hit in the first quarter of 2020. That's really because it really only hit March, the month of March. The second quarter fell at an annualized rate of 31%. But you need to understand that's a seasonally adjusted annual rate, meaning that if we lost GDP for 4 consecutive quarters, we would have lost about a third of our economy. So in these hugely volatile times, I think it's worthwhile to take a look at year-over-year growth or loss. So we lost 9% year-over-year in the second quarter. We gained back 33% annualized in the third quarter, but there was still this gap. We were still down 2.9% year-over-year. Fourth quarter still had some momentum, grew 4.1% annualized, but still down 2.4%. The Nonpartisan Congressional Budget Office suggests that we could be back to our peak real GDP the third quarter of this year. You heard that earlier this morning. there's a whole range of forecasts that are out there. Goldman and Wells Fargo are now projecting 6% growth this year. If that comes to fruition, that would be the fastest growth in decades. If we're in the 4 to 5% range, that would be the fastest growth since 1999. So there's this real expectation that we may see a fast snapback in economic growth, and there's a lot of reasons for that I'll discuss in a moment. But regardless, we're still below potential GDP. And the reason why we'll be below potential GDP until 2024 or 2025 is because of this persistent unemployment that we're in right now. When we take a look at job growth or job loss nationally, I'm going to try not to say the word unprecedented too many times today, but this was an unprecedented fall. We lost 22 million jobs, greatest job loss in our history, greatest percentage job loss as well. And then after that initial shock from COVID, the initial shutdowns, the initial stay-at-home orders, we started to see the economy reopen. We saw record growth in jobs. But with each subsequent month, the job growth slowed until we got to December, and we actually saw job loss again in the month of December, about 140,000 jobs. January, we resumed growth, but we only added back about 40,000 jobs. We're going to get a jobs report out tomorrow, and it's in the 100 to 200,000 range is what the consensus is calling for. But a little bit of perspective. This is the last 5 or 6 recessions. And what I've mapped here is peak employment, and then that gap until we got back to peak employment. So the tech bust of 2001, it took about 2 years for us to hit bottom, and then it took another 2 years for us to recoup those job losses and actually start growing new record jobs. The Great Recession, which we talked about tirelessly as being the worst recession since the Great Depression, during the worst month of that Great Recession, we were down 6.3% of our total employment nationally. Fast forward to the pandemic-induced recession, we lost almost 15% of our jobs, faster than we've ever lost them before. And even though we've had a remarkable recovery, we're still down 6.5% from peak. So we're still down more right now than we were during the worst month of the Great Recession. So that's some perspective that we need to keep in mind. The losses and the recoveries are very different depending on where you are in the country. Colorado is 26th for job growth, or what we need to be saying now is job loss. We're down about 5.4% year over year. But the worst hit places are places like Hawaii and Michigan and New York and Massachusetts and Vermont and Connecticut. Hawaii's down about 13% year over year. To our west, Utah, Idaho, they're leading the nation. They're not only up slightly year over year, but they're up over their prior peak. They're up about 0.6%. We're being outcompeted a little bit right now by places like Arizona, Nebraska, Wyoming, Montana, Texas. So sort of this mid-continental Western, Rocky Mountain region, we're only ahead of New Mexico. So that's a very different place than we've been in a while. Talking about a few communities, different types of communities that have been impacted, we also think about age, race, ethnicity, gender, and educational attainment. So look how people were impacted so differently from this event. The green bar is showing February, before the pandemic really took hold. The red bars are showing the worst point of the recession in April and May. And then the gold bars are showing where those communities rest right now in terms of the unemployment rate. Our youth were disproportionately impacted. Early on, we saw more women file for unemployment than men, and that has converged much more closely now. We see people with a high school diploma or less than a high school diploma have much higher rates of unemployment than people with a bachelor's or a master's degree. And we see differences among the Black, Asian, and Hispanic and white non-Hispanic communities. But if we trace these cohorts back to industries that are sort of dominated by some of these cohorts, it makes a lot of sense why we've seen higher unemployment rates connecting those dots. For instance, early on, women had much higher unemployment. But if we take a look at the industries that are dominated by women, for instance, nursing, servers at restaurants, personal care services, hairdressers, those are also the same industries that were hardest hit by this recession early on. So it's not a huge surprise that we see higher unemployment rates among that cohort. Our youth were also impacted by shutdowns of the tourism industry, entertainment sectors, restaurants, retail. Those sectors are dominated by younger people. But also think about this ability to work from home. So this is new data that came out from the Bureau of Labor Statistics this year. It's teleworking due to the pandemic. We saw in May that about a third of workers were teleworking because of the pandemic. As economies started to reopen, this rate went down and then started to re-increase with the rise of COVID cases. But take a look on the left side, the industries that were more apt, more accommodating to work from home. First one is professional and technical services. So software, engineering, R&D, design, accounting, information services, finance, education. All of these have a much higher rate of working from home compared to industries like agriculture, restaurants, bars, construction, retail. All of those are sort of the face-to-face industries, or the have to be there in person to do the work industries. But think about who works in these different industries. People who are working as engineers and accountants, et cetera, also tend to have higher educational attainment. It takes certifications, it takes a bachelor's degree, might take a master's degree. So we see a lot of differences depending on educational attainment. So people who have educational attainment had lower unemployment rates, had a greater ability to work from home. They saw much smaller disruption in terms of their employment. So we talked about the vast amount of employment loss. 22 million jobs lost, added back about 12 million. There are so many things that we would expect to see during a recession. We look at historical events to try and inform current events or future events. And there's been many unexpected things that happened during this pandemic-induced recession. First, we did see that record fall in jobs. We saw a record decrease in employee compensation, which makes sense as we lost jobs. But we saw a record increase in personal income. Why would we see a record increase in personal income during a recession? We saw a record increase in transfer receipts from government to households. So this took the form of not only unemployment benefits that we would normally receive, but augmented unemployment benefits from the federal government, stimulus payments that went out, and other sort of federal support. And even though that waned a little bit as the year went on, we still saw year-over-year increases throughout the year for personal income. And in January, we saw another surge in personal income as the December stimulus was rolled out. Transfer receipts were up 80% in January, year over year. The good news is that employee compensation came back. Employee compensation in January was up year over year. So that's a positive signal about the economy starting to get back on a good footing. But thinking about the relationship between income, spending, and savings, this slide shows very well the spike that we had in personal income, and then how this sort of started to normalize a little bit and then increase again. When the stay-at-home orders went into effect, people sort of stopped, or I shouldn't say stopped, slowed down their consumption. But as their incomes were largely, in aggregate, not interrupted, we saw consumption come back. And it's about flat year over year in January. The personal savings rate, this is a percent of disposable personal income, spiked to the highest level that we've seen since the Great Depression. And even though this has come down, in December, it was back to levels that we haven't seen since the late 1970s or early 80s, and then it spiked again. So incomes were largely not interrupted. On the consumption side, we usually spend a boatload of our income on services, hotels, travel, airlines, restaurants, etc. A lot of that's sort of off the table. It's unavailable right now. So people shifted their attention to goods, or their incomes weren't really interrupted, and so they noodled away some of that money into savings. But what did that mean for retail sales? Retail looked like it was going to have a disastrous year in 2020. We saw a record, I'll say unprecedented decrease in retail sales, but then we had a V-shaped recovery in retail. And then retail started posting records year over year. And in January, we had 7.3% growth year over year in retail sales nationally. Remember that that's comparing January of 21 to January of 2020. That January 2020 was a pre-pandemic month. So that's phenomenal growth in retail sales. There's been winners and losers, and I think breaking down those winners and losers within the retail sales categories are sort of emblematic of what we're seeing in our broader economy. So even though retail itself has done okay or well, the sectors that have grown include sporting goods. Those bicycles flew off the shelves. Building materials and garden equipment. That's partially because people are doing all of those projects at home. There's a lot of demand for housing right now, but also those lumber prices that they were talking about earlier showed up as higher retail sales prices. Grocery stores had a banner year, but on the other end of that spectrum, restaurants and bars, clothing stores, department stores, all were on the losing end of that equation. So why am I telling you this long story about consumption and retail? Because this is really an important component for the Colorado economy and for how we fund public government in Colorado. So the last legislative session had an emergency meeting. Last year, they looked at cutting the state budget because it looked like retail sales taxes was going to be disastrous for the year. Fast forward to the end of December, 2020 was a growth year for retail sales taxes, up 2.3%. But when we take a look at across communities in Colorado, winners and losers. City of Boulder was a community that ended up losing 8.8% in 2020. Louisville was down about 3%, but Longmont was up 4%, and Superior was up 18%. And Lone Tree's data lags quite a bit from what I could pull, but was down 28% in July. So there's so much variation across the state. One, there's different tax bases that each of these communities are taxing. But two, it depends on the type of retail that they have. Do they have the big box stores that really flourished during this pandemic? Do they have a big mall that was shut down for a long period of time? What does their tax base look like from a community standpoint? Are they dependent on students not only being back at the universities, but are they dependent on those students living and going to school in a university town so that they're spending money in that university town? Are they dependent on tourists and day commuters to be spending money in those communities? The Colorado sales taxes statewide, this is a really sort of janky pattern because of seasonality that happens in retail sales. But I'll show it one slightly different way. And this is showing this is showing total sales taxes by month for the last 5 years. And so now you can see the seasonal pattern. January is always a high month because that's reflecting December sales. We see a low that starts to happen in February and March, and then it starts to increase again. 2020 started off a good year. January and February, normal patterns. March, a pretty normal pattern. Then April was that interrupted month. It ended up setting us back about 4 years. But then as we progressed through 2020, June, July, August, September, October, all ended up being up year over year. Totally unexpected. Inflation is another component of these retail sales. This is prices, how we're pricing goods and services. The downside for Colorado is that while our economy has done better over the last decade, our employment growth has done better. We've also had higher price growth, and this has been consistent for all 8 of the past 8 years. A lot of this was driven by the cost of shelter for the first half of this period, but it's much broader than that. And so I think you need to keep in mind these higher inflation rates and what that means for quality of life in Colorado. For many people, the price growth has exceeded wage growth. So we've seen real wages go down for people, and we're seeing the cost of shelter, cost of rent, cost of mortgages go up faster than the rate of inflation. So it's sort of chipping away at people's ability to purchase other goods and services. So zooming into the Colorado economy, want to start out by just sharing Colorado's rank among the 50 states in some key metrics that we watch. And I have up here where we were last year at this time and where we are right now. So Colorado was a leading state during the Great Recovery following the last recession. We had the 4th best employment growth over that 10-year span. And almost every metric we looked at, we were a model economic growth state. But this recession has really taken a bite out of our rankings. Notably, employment growth just year over year. A year ago, we were 9th in terms of job growth, and now we're average. The unemployment rate, a year ago, we were 5th low. We had the 5th lowest unemployment rate. In February, we had the 3rd lowest unemployment rate nationally. Now we're 47th highest in the country. That is completely flipped. The FHFA home price index, which only looks at repeat sales, it doesn't even include all of that new stock of housing that's come online. Now we look a little bit more average, we're 27th. But mind you, the all transactions index was up about 5.8% year over year. That's average, you know? The purchase only index was up over 10% year over year. There were 2/3 of the state recorded over 10% growth in the purchase only index year over year in the 4th quarter. Population growth, we're a state that benefits from a really perpetual population growth. There's only one period out of the last 50 years where we lost people to net out migration. That was in the mid 1980s. 2020, 2021, 2022 are slower population growth years for Colorado. We're sort of the slowest growth since the early 2000s. Net migration is the slowest growth since the early 2000s. But still, it's growth nonetheless. And what we think about, though, is population growth around Colorado. This is the projection from the Colorado Demography Office for 2021. In 2019, the Demography Office estimated that 16 Colorado counties lost population. It's all of the blue counties here. In 2020 and in 21, they were estimating that 25 or 26 counties would lose population. Some of this is to net out migration. Some of this is to more deaths than births in some of these small rural counties. But what we think about during this pandemic is how has the pandemic changed what this map will look like when we see that data come in? Will we see a reversal in some of these rural communities, in some of these mountain resort communities? Or how will they actually show up on paper? Is it people buying a second home and spending 3 months in those communities? Are they actually long-term renters? So they're not going to show up as permanent residents. So really only time will tell to see if we can reverse some of those trends, but this ability to work from home, to work remotely, should be a catalyst for growth in some of these areas. We've taken a look at jobless claims as a greater real-time metric for how the employment sector is doing. There was a record increase in jobless claims early during the pandemic in March and April. You can see this recovery that happened, but as the virus resurged, as the mandate to close down businesses increased, we saw another wave of jobless claims, people signing up for unemployment benefits. When we break this down by industry, you can guess what some of the key industries were that were impacted. It's our tourism industries, restaurants, bars, and other sectors. But taking a look geographically again around Colorado, who's been impacted by unemployment, who's been impacted by these jobless claims, this is showing unemployment as of December of 2020. What I like about this map is that there's more continuity around the state. So the dark brown and the light brown areas, it's just more cohesive as we look around Colorado. The Eastern Plains, our agricultural counties, these areas have recorded the lowest unemployment rates in Colorado throughout this event. Still, between 0 and 3% pretty consistently. Our mountain resort communities have improved dramatically. They went from having 20 to 26% unemployment during the height of this recession, now to being more in the 8-9% unemployment range. So there's certainly some good news for some of these communities that were initially hit very hard. But I just want to illustrate where those mountain resort ski counties compare to the 3,100 counties across the United States. So I've included all 3,000 counties on here. You can see that our mountain resort ski communities in Colorado have among the highest unemployment rates in the country. So while things have improved out there, there's still a long way to go. And even though we can throw a lot of stimulus money at the economy, and there's a lot of reasons to do that, there's a lot of benefits to doing that, but we're not going to see a recovery in the labor market until, I believe, until we get to herd immunity, until there's mass vaccinations, because a lot of these communities are suffering from an inability to accommodate all the guests who want to be there. I think there's plenty of demand. People just can't, they can't accommodate as many people as want to be in those communities because of restrictions on what they're able to do. In December, we were forecasting a loss of about 150,000 jobs in 2020. We think that that number could even be revised down based on some statements by the Labor Department last week. But we were projecting growth of about 40,000 jobs in 2021. And you can see this wide confidence bound that we put on those estimates. We still think that's reasonable, but there's so much uncertainty here because of the vaccine, because of when we get to that herd immunity point. If we get there, as Governor Polis was sharing this morning, if we can have a more normal summer 2021, then we could see a resurgence of those jobs in the tourism sector. But if it takes longer than we expect, then that's going to definitely hold back our potential. Taking a look at employment growth around the state. This is a reversal from the story we told last year or 2 years ago. It used to be the Metropolitan Front Range, Denver, Boulder, Fort Collins, Greeley, that recorded the fastest employment growth. And we saw Grand Junction, Colorado Springs, Pueblo lagging the Metropolitan Northern Front Range. This is reversed. Now we see Boulder, Fort Collins on the far right side. We see Grand Junction as one of the few metro areas nationally that are recording job growth year over year. So we're seeing activity spread out a little bit from where we normally see it. Industries that have showed the greatest impact, carried the greatest weight year over year, continues to be accommodation and food services. So hotels, bars, restaurants, ski resorts, concert facilities, sporting facilities, museums, state government, local government, healthcare. And even though we're projecting growth in 2021 for all of these sectors, we think that tourism will have the greatest growth in 2021. They're still going to be below peak. There's such a gap there that they need to fill that it's going to take a while before we get back to normal. Taking a look at a slightly different community, let's take a look at income cohort. So I grouped industries by income level. The high income cohort, industries that pay on average $75,000 or above. So think of finance, engineering, federal government, professional and business services, all of those industries grouped together. Think of what they are, right? They're industries that have that ability to work from home. They're high paying industries. We saw at the worst point during the recession that they dropped about 1.8% of their total jobs. And by the end of December, they were down only 0.4%. So I would call that relatively unaffected. The lowest income cohort of industries, so it's those bars, restaurants, retail, even healthcare, hair salons, etc. That cohort lost 25% in a matter of 2 months. Rebounded during the year, but in December, as those COVID cases increased, that's the sector that took the hit, and they were down 10% by the end of December. So that critical tourism industry, this is just zooming in on it a little bit. You can see how hard it was impacted in April, and even though there was a recovery, this is the sector that ended up bearing the brunt of the sort of waning recovery that we saw in late 2020. Also emblematic of that is Denver International Airport. We saw phenomenal losses in airline traffic activity. Full year 2020, DIA was down 51%. But the story that we've been telling for the last 10 years is that DIA is the 5th busiest airport in the US and 10th busiest in the world. It's something like that. Because of this event, Denver now jumped up to the 3rd busiest airport in the US. We're having sort of this outsized recovery. Even though we're still down phenomenally, we're doing better than many other airports out there, which suggests that people are trying to get back to Colorado. Very quickly, want to talk about the construction industry. Nationally, value of construction in 2020, another banner year. Record value of construction. These are nominal terms, so it's not really adjusted for inflation, but up 4.7%. Most of that growth was on the residential side, up about 12%, where non-residential or commercial was flat. When we take a look at the segments, take a look at what grew and what did not grow in 2020 nationally. I'm going to pick out a few segments on the growth side. Power, public safety, water supply, highways and streets, sewage, communication. On the losing side, we have manufacturing, lodging, office, amusement and recreation. So to me, a lot of those growth sectors are either public funded or in partnership, like a 3P project. Whereas a lot of these more pure private sector developments saw a pullback in activity. What did that look like in Colorado? If the nation was up 4.7% in 2020, Colorado was up 3.6% in value of construction. Like the nation, Colorado residential grew double digits. Commercial was down. Okay, so here's what's interesting. When I strip off the North Metro MSAs, Denver, Boulder, Greeley, Fort Collins, the rest of Colorado grew 8.3% versus that 3.6%. When I strip off one huge project in Cheyenne County, Little Cheyenne County in 2019, the rest of Colorado grew 22% versus 3.6%. So this shows that activity may be spreading out from that Metro Front Range. Same story for residential building permits. State was up 11.6%. Rest of Colorado, excluding the North Metro areas, was up 31%. And when we take a look at overall Colorado growth in 2020, 40% of the building permits happened outside of the North Metro Front Range. Zooming out to a longer period of time, though, Colorado ranked 9th over the last decade in terms of the volume of building permits. Okay, we're 21st for population total, we're 21st for employment total, we're 8th for population growth, and we're 9th for building permit growth. We are one of the hottest housing markets in the country. The home price index, this is almost the exact same story of what I told about employment growth. This is a reversal from a couple years ago. Faster home price growth in Grand Junction, Colorado Springs, and Pueblo, slower growth now in the North Metro areas, but this is still really fast growth that we recorded in the fourth quarter of 2020. I want to end by talking about a few other indicators that we're watching that gives me a little bit of optimism. One, Colorado is a small business state. You probably are all pretty familiar with this. So we punch a little bit above our rate and weight in terms of the percentage of small businesses. We're also a young establishment state. we're actually we rank 4th in the percentage of our firms that are 5 years or younger. I think to the left of us here, I think those are places like Florida and Nevada, maybe. Okay, so we also have this entrepreneurial community, the startup culture that we can measure in terms of business filings with the Secretary of State's office. There's another data set nationally where we can take a look at business applications. And we saw this business activity wane during the start of the pandemic. But then we saw it really come roaring back after the economy started to open back up. There's a signal that people are out there trying to start up their own businesses, which is important because we know that there's a positive correlation between young businesses and employment growth. I've measured this over many different time periods, but the fact that Colorado is a young state, that we have a lot of these business formations, also is an indication that we experience faster employment growth than other states nationally. We're still behind states like Nevada and Utah on this chart. So this gives me some optimism. That signal of those, the new business formation could bode well for more employment growth down the road. I heard this said earlier, but bankruptcy filings, this is another metric that surprised me, was down year over year for the full year of 2020. It was down each quarter year over year in 2020. And I think this is probably largely to do with programs like the PPP that help stave off some of the bankruptcies that we otherwise would have experienced. But these businesses aren't rushing out and filing for bankruptcy like what we saw during the last recession. Foreclosures were down through the second quarter of 2020, again, probably because of some of those programs that were rolled out, but there's sort of fewer warning signs. Delinquencies with the Secretary of State's office, it seemed like we would see companies be delinquent on their standing with the state because of the pandemic. But what we in fact saw was delinquencies decreased for all different types of organizations as we marched through the year. So another positive signal, and I checked this for January and February too, and it still continued to come down. You know, national and state expectations. This is a survey that we do of business leaders in Colorado, and the second and third quarter survey is live right now, and we'll report that out on April 1st. But what they told us in the fourth quarter of 2020 is they were sort of reticent about the first quarter of 2021 because they saw how the vaccines were slow to roll out, but they're super bullish about the second quarter of 2021. And they're optimistic about getting employees back in the office in some sort of regular fashion in the third quarter of 2021. So in closing, I just want to circle back to that puzzle. We did, in fact, find that last puzzle piece. My 6-year-old was playing in the living room and he looked underneath our coffee table, far away from where we put this puzzle together. And he was so excited, went running around the house and saying, "Look what I found, look what I found." And so we were able to complete this puzzle about a week later. And I think there's another parallel here that we're just, it feels like we're on the verge of a good economic recovery that can bring in a lot of those people that have been left out of this recovery, because as there's mass vaccination, as life starts to get back to normal, as people are able to travel again, we're going to see a whole wave of those jobs come back that are still sort of idle because of where we are in this event. And that's where I will stop. Thank you.
Great, Brian. Thank you so much for your presentation today. We do have a couple minutes left of your time slot, so I would love to throw you a couple quick questions while we still have you today. So one question that came in this morning was from Mike. Sales tax receipts are encouraging for the state. What about other sources of revenue for the state and local governments, like property tax, income tax, et cetera?
Yeah, that's a great question, Mike. So I would say that all of those property tax revenue streams performed better than expected in 2020. normally if we see incomes go away, we would see income taxes go away, right, or decrease. But PPP, stimulus checks, there are a lot of reasons why income didn't go away, therefore income taxes ended up holding up. Even think about investment income. Do you know that household wealth hit a record $140 trillion at the end of 2020? The stock market continues to oscillate around record highs. So income that comes off of those assets held up. And so that also helped out income taxes. Property taxes is something that we were worried about. That assessment cycle is every 2 years in Colorado. So that doesn't show up right away, except for transactions that happen. But you're all experiencing it, especially on the residential side. Record home prices in the state, which have sort of helped support the property taxes that's being collected by all of these individual jurisdictions around Colorado.
Great, thank you, Brian. And one final question this morning, I think this is an important one, comes from Samuel, who's one of our students joining us today. He's wondering, is there any current data on employment for recent graduating college students that you can share with us today?
I'm not the best person to ask about that. I mean, we know how our own students are doing within Leeds. And we know that, this year is harder than it's been out of the last 6 years. So, and that's not a huge shocker. I think what bodes well for the college student cohort is that the unemployment rates for people who have a bachelor's degree or who have a master's degree are still incredibly low. They're sub 4% nationally. So I still think it's an easier job market right now than it was during the last cycle that impacted all degree holders much more than what we're seeing right now. So I'm still optimistic. I still hear companies say that they're having a hard time finding workers. And I think it's, if bachelor's and master's degree holders have a really low unemployment rate, there's still a lot of competition for that talent. So I think discouragingly, I think your search will be a little bit harder this year, especially depending on the industry that you're trying to break into. But encouragingly, it's better for you because of the investment that you've put into your education than it is for some other people.
Great, thank you, Brian.
Brian, thank you very much. Thank you for answering my question as well. I do want to share with the group that last year when you spoke, I'd written this down at the time, you did an outlook and a presentation, and you said, quote, "I'm cautiously optimistic, but there is this thing out there we call a black swan event. And this virus in Asia could be that black swan event that trips everything up." So I think you were, rare is it that an economist is right and the timing is right also at the same time. So thank you for that then. Thank you for your wisdom. And I have to say thank you for your optimism as we sit here today. If you were right on the downside, I'll take your word on the upside. So Brian, thank you very much for joining us today and sharing your wisdom. Megan, back to you.
Boston Properties is the largest public owner, manager, and developer of Class A office space in the United States, and development of world-class real estate assets is in our DNA. Since our founding as a private real estate development firm in 1970, we have excelled because of the skill, dedication, creativity, customer focus, and integrity of every Boston Properties employee. Your collective efforts have created great value to our customers and shareholders for over 5 decades. This is a team effort, and we thank all of you for your relentless commitment. Boston Properties became a public company listing on the New York Stock Exchange in 1997, and at the time set a record for size of IPO for an office company at over $900 million. This capital, as well as the created public currency, gave the company the fuel that it used to accelerate its growth in the decades beyond.
Going public allowed us to purchase and then redevelop the Prudential Center, to expand into Northern California and purchase the Embarcadero Center, to dramatically increase our footprint and start our development in Reston, Virginia, which is now Reston Town Center, and then to acquire sites in Manhattan. And then in 2014-15, the Salesforce Tower, which is the pinnacle building from an iconic geographic perspective in San Francisco. It's really one of the most exciting projects that the company's ever developed.
What we do matters. We're the biggest public company in our space. We're the largest landlord in many of our markets. We build the most notable buildings. We are watched by the outside and at times emulated. I'm very proud of that. We need to continue our growth, both in our core markets and in new ones. We need to continue to be a source of positive external impact by creating jobs, refreshing neighborhoods, and advancing sustainability through our developments. We need to continue to improve our diversity internally and help advance the equity in our communities. Sustainability is important to Boston Properties because it's important to our customers, our communities, our shareholders, and our employees. The built environment creates 40% of carbon emissions worldwide. So property companies like Boston Properties have an important role to play in trying to solve the climate crisis. By focusing on sustainability and other community impacts, we as a result are a more purposeful company. Our team at Boston Properties can never become complacent. We need to remain curious. There are external trends and models that we can always learn from. We need to be constantly challenging ourselves to be a leader, to be the best, to innovate, and to grow. My vision and hope for the future of Boston Properties is to become the most emulated property company that serves as the industry benchmark in terms of financial performance, sustainability, governance, community impact, and diversity.
I hope that the entrepreneurial spirit that we have tried to nurture and that has prospered across our different regions continues to allow us to be the most successful developer, manager, owner of institutional quality real estate in the markets that we operate in.
Our passion for our cities are well beyond just the bricks and mortar of our buildings. It's investing in the social fabric of our communities.
And it's ultimately the demand for our product that is going to drive us to do what we do. I'm confident that we will figure out ways to find new assets to develop, acquire, and reposition.
As I look back on our 50 years of success, I am proud and honored to lead Boston Properties into the next 50 years, knowing that our foundational culture of excellence and integrity remains strong and resilient, and that our continuously evolving strategy is meeting the current demands of our customers for great places and spaces.
Good morning. I take great pleasure in introducing Mike LaBelle. Mike is a proud CU graduate from the class of 1986 and is the Executive Vice President and Chief Financial Officer of Boston Properties. Mike also graciously serves on the International Advisory Board of the CU Real Estate Center. Take it away, Mike.
Great. Thanks, David. Appreciate it. It's great to be here. It's a pleasure. I wish we were there in person, but I know, I'm excited. And I know Owen is excited to share what we're seeing in the office markets today. Before I get started, though, I do want to thank you, Dave and Campbell and the rest of the team for putting the forum together today. I know there's a ton of work that goes into this event, and we all appreciate and know that you're both volunteering your time to put this together. The other thing I want to say is I want to thank Mike Kercheval, and I also want to thank Richard Morgan and Cindy Thomas for your leadership at the Real Estate Center and at the International Advisory Board. It's been a great experience for me. I've really enjoyed being part of the board and getting the opportunity to come back to Boulder to see you and to meet with students. And I hope that we can get back together in person in the fall for our meeting this fall, which would be great. I did get to catch Brian's presentation there, and I thought it was a great presentation. And the one thing I really liked is he said we're all going to be back in the office by the third quarter of 2021. So I certainly hope he's right with that prognostication. For those of you who aren't familiar with Boston Properties, we put that little video up to try to provide some historical backdrop and really a view into what our values are. We are the largest publicly traded office company. Our total market capitalization is about $30 billion. Little less than it was a year ago because our business has been affected by the pandemic. We own 200 properties and 51 million square feet of space that's located in Boston, including Cambridge and suburban Waltham, Massachusetts, New York City, Princeton, New Jersey, Washington, D.C., Northern Virginia, the San Francisco and Greater Bay Area, and Los Angeles. And as you may have seen on the video, some of our notable buildings include the GM building in New York City that we bought right after the crash in 2008. The Prudential Center in Boston, which is one of the first acquisitions we made after we went public, and Salesforce Tower in San Francisco that we developed and built a few years ago. And one of the things that really does set us apart from other public real estate investment trusts is that we are a developer. We've always been a developer. It's been in our DNA. Just in the past 5 years, we've developed 9 million square feet of space and over $5 billion worth of real estate. And currently, we have a pipeline of 3.7 million square feet of office properties with a total investment of $2.2 billion. Fortunately, we generally seek pre-leasing in advance of development. And right now, our pipeline is 87% pre-leased. So Mike asked me to provide a brief summary of how a CU grad like me was fortunate enough to actually end up as a CFO of an S&P 500 company. And I'm sure there was a lot of luck involved in this, but I think I also made a few good decisions along the way. One thing for sure, I'm confident to say that the day I graduated from CU 35 years ago, I was not the same person that I am right now. I think that I was probably a lot more fun. I definitely was more relaxed, probably in a Colorado kind of way. And I definitely spent a lot more time on the ski slopes as well. But, my time at CU was a great experience. It did help instill in me a really strong work ethic and gave me some people skills that I really have needed to be successful. And, the two things that I think are really important is a strong work ethic and also patient and thoughtful decision-making. I think those are two of, my most important attributes for success. Like many of you, I didn't want to leave Colorado when I got out of school, but Colorado was in a pretty tough place in 1980, the late 1980s. There was a big energy recession going on. So I ended up heading to New York City, and I started a career in finance, and I kind of fell into real estate in the late 80s when I was working actually as a bank examiner, and the banking industry got itself into a lot of trouble with too many speculative, high leverage construction loans. Some of you may remember all the bank failures and the government takeovers that occurred in the early 90s. I was in the middle of that. I do have fond memories, though, of doing discounted cash flow valuations longhand. This was all before Excel. And, that's really where I found my passion for real estate, was at that time. And, after that, I spent 8 years as a commercial real estate banker in New York and then in Boston. And then I made my best career decision, which was joining Boston Properties 20 years ago to help us raise capital. At that time, we were a $7 billion company, so we have experienced some pretty good growth in that time frame. I would like to bring Owen Thomas into our conversation. So I met Owen for the first time early in my tenure at Boston Properties. He may not even remember this, but his team at Morgan Stanley was helping us with some, I would say, rather creative deal structuring on an asset recapitalization that we were trying to accomplish. But you know, I really didn't get to know Owen until he joined us as our CEO 7 years ago. And I have to say that, you know, our board could not have made a better decision for a CEO coming from the outside into our organization. And I have truly enjoyed the relationship, Owen, that we have built over the last 7 years. I want to welcome you to the University of Colorado Forum, Owen, and perhaps you'd like to share a few words about your own journey to Boston Properties.
Yeah. Well, Mike, thanks for those kind words, and pleasure to be with all of you today. Look forward to talking about the office markets and anything that you all are interested in. In terms of my own path, quickly, I actually grew up on a dairy farm in the Shenandoah Valley of Virginia. And my father, in addition to being a farmer, had a real estate business. He was a broker of farms, and we developed some farms, and I worked there as a teenager. And I went to the University of Virginia. I'm a proud Cavalier. And I got an engineering degree and worked at that for a while, but didn't really like it, and went to Harvard Business School and took a real estate class and kind of reignited my interest in that. And so I joined Morgan Stanley out of business school, was there 24 years. Though I did work on our banking business and worked with great clients like Boston Properties and Mike, I spent most of my time on the principal side. Morgan Stanley had raised some large opportunity funds. We bought the Lend-Lease US platform, and now have had the Prime Property Fund. So I was there for 24 years. I did some other jobs outside of real estate, left about 10 years ago, became the chairman of Lehman Holdings, which was the company that was put together to liquidate Lehman post-bankruptcy. And then about 8 years ago, as Mike described, the company was looking for a successor to Mort Zuckerman, who was the one of the two iconic founders of Boston Properties. And I joined then, and you know, I've had a great experience working with Mike and Doug Lindy and the rest of our management team.
Great, thanks, Owen. So why don't we get into the meat of our discussion, which is what will be the impact of the pandemic on the office markets, and how will the future utilization of office space change? So there are a lot of people out there discussing this and talking about the demise and the impacts of mobility, work from home, remote work, or as some people call it, work from anywhere. What do you think will be important about the office after the pandemic and in the future?
Yeah, so this has been a really interesting year. You know, I think we being everybody on this call and everybody in the real estate business, frankly, anybody in business, has had to think a lot about what is an office do for me and for my company. And we've learned a lot and thought a lot about, you know, the product that we offer to all our clients. And it's wildly confusing, I think, to the marketplace, you know, hence, you know, where our stock is performing. I think it's performing, you know, it's down quite a bit from where it was before the pandemic. And I think it's more on, it's not on our loss of income, it's more on concerns about the future of office. And it's confusing, you know, even last week in a single day, you know, HSBC announced they were going to use 40% less space going forward. And Goldman Sachs, who's in this, you know, more or less the same industry, said, this is not the future. We expect everybody back in the office. This is not our future state. So different customers are saying different things, even in the same industries. So a couple of things that I would observe based on conversations we're having with our customers and surveys that we have studied from Gensler and some of the other providers. I think business leaders generally want their companies back in the office. I think they feel that they are losing collaboration, creativity, innovation, ability to onboard new people. The culture is starting to crumble of their companies, and they want people back. And I think if you look at surveys of workers, who, by the way, today are primarily millennials, they also want to come back. You know, they want to learn, they want to be next to their seniors. They think they'll learn more by being in the office. So I think all that, you know, bodes well for the future of office. The issue is, you know, we have gotten accustomed to working from home. Many people have long commutes. come into the office can be inefficient. And so I do think that employees are going to want to work more flexibly going forward. And I think many employers will provide that flexibility. So then if you kind of come to the question about real estate, so when you come to the question of real estate demand, you say, okay, well, if people going forward, if employees are going to work in a hybrid model, meaning they're out of the office 1 or 2 days a week, as a company, you're going to say, well, great. That means I can therefore save money on my office space. I can take less office space. Well, to do that, you have to do one of two things. We have to do two things to make that happen. One is you have to schedule people out of the office. And in other words, everyone can't work from home on Friday. And then second, you have to, when people are in the office, they have to go to a flexible work approach. So in other words, everybody has to be hot desked. And if you look at these, surveys that are done, and what employees are saying is that they would rather have a fixed workstation and not have the work from home benefit. So again, I think it's all very much up in the air as to what the future holds for office. But we don't think the work from home is going to be an enormous headwind. And also, I think you could argue from a pandemic standpoint, there may be more spacing required for employees. And I also think employers are going to have to increasingly provide amenities and collaboration space, in their space to lure their employees back to the office. So that could also create some additional space demand. So you got a lot of moving parts, different companies, different industries are going to approach this differently. But, I do think the office will continue to be an important asset class.
One thing, Owen, that I like the anecdote we heard from one of our clients is, we can do the downhill work just fine. We can get our quarterly reporting done. We can have our staff meetings and do all this stuff via Zoom, but it's the uphill work that we can't get done. The creative work, the collaborative work. And when we think about who our clients are, right, they're innovators, they're knowledge-based workers. Many of them are in the tech sector or the life sciences sector. And the mantra is really, you innovate or you die. And innovation happens when you're together and you're collaborating and you're bringing your talent together. So I think that that's one thing that, will help us. The other thing that's interesting, and it was part of the last presentation when we were talking about employment, office jobs have not been impacted by the pandemic. The loss of jobs is all in the service sectors. It's not in the office using jobs. And most of these companies that are using office space are doing quite well. Many are growing and adding people. So it is going to be a little different from other recessions where you had a lot of job loss in office using spaces. So, we're seeing it across our portfolio as you're seeing some incremental expansion. And you're seeing companies that are continuing to grow their revenues, which I think will be quite helpful, in offsetting, any impact there may be. The other thing is obviously we're still signing leases, as you know, Owen. Yeah. So, we signed almost 4 million square feet last year, and they're still long-term. The average lease length in the fourth quarter and the third quarter, for that matter, for our company was about 8 years. So still pretty good.
Yeah, and we're also collecting 99% of our office rents. So, which, has been a little unsettling when people aren't using your product, but they're still paying their bills and they're paying for it. The other thing I think about on office is, think about two companies competing with one another. Which one's going to be more successful? The one that's all virtual or the one that is going to be working together, at least part on a hybrid model in the office? Maybe you could argue the virtual one has more access to talent, more broadly across geographies, maybe even outside the US. But I do think companies that are working together in the office are going to be more competitive, winning business, which at the end of the day is going to drive behavior.
Yeah. You touched on a couple of buzzwords. Reverse densification was one. We've been dealing with a headwind of densification for the last 15 years, and now they're talking reverse densification. And then collaboration zones. And, I'm wondering, do you think this could actually increase the amount of space that people might need? And are we seeing any signs of it?
Yeah. Well, I think I'm not sure you're going to get an increase in space, because I think the one thing you mentioned, Mike, that's most important is we went through a recession, and there are segments of industry that went through a pretty tough recession, and that always takes down the demand for office space. I think some of that's getting labeled as work from home, but it's not. It's really just recessionary impacts. So I think this notion of two things. One, spreading out for health security reasons. I mean, I do think now we all know I lived in Hong Kong, by the way, for 3 or 4 years, and often people were wearing masks on airplanes, and I didn't really understand why that was going on. And now I think you're going to see masks a lot more in the United States when people are ill. You're going to be a lot more sensitive about health security. You know, with the vaccine, I'm confident, the virus is going to largely disappear. And I'll use the word largely. It's not going to be eliminated. So it'll still be out there. And I just don't think employees are going to sit at these benches, less than 6 feet away from each other. And so I do think you're going to have some reversal of densification. And I do think that, and this is going to be incumbent on both landlords and on our tenants, our customers, we have to make the office more enjoyable and fun to go to. So, and part of that is the amenities that we will develop as landlords. And part of it's going to be the space that you create as an employer. You want to lure your employees. You want them to be in the office, and you want them to want to be there. And I think that's also going to create more demand for space.
Yep.
So I'm not sure it's going to increase the demand, but I think it'll lessen the blow from the pandemic.
Yep. It's interesting because as we look across our portfolio, and we've got 4 million square feet under development, so some of that is being built out by tenants right now, and we're not seeing our tenants really modify their space build-outs significantly. There's talk of it, and we know that our clients are talking to design professionals about options, but at this point, I don't think we have any real things to point to, where people are building out space significantly differently than they have before. So I think that it's too early to know, and we'll have to see what happens there. You touched on amenities, and amenities at office buildings have really developed, and they've become more important this past cycle with our clients. Our clients looking to us to provide them what we call great spaces and great places in and around the buildings to help them attract and retain workers. So we as a company have been ahead of this curve with our own portfolio. Going forward, I'm sure this is going to continue to be critical, as you say, to coax workers back. How do you think these amenities are going to change? What's important? What do you think we're going to have?
Yeah. Well, I think it's going to be a lot the same, maybe with more focus on health security matters. So I do think, having great restaurants, having places where employees can have lunch together that's why you have downtowns, so that you have people coming in from all these different industries that are working close to each other, and they can get together and network and do business with one another. So I think having the great restaurants, the great shops, interesting places to go. I think being proximate to public transportation. One of the things that's really interesting in New York right now is there's a lot of touring activity going on in traditional Midtown. And a lot of New York City moved to Midtown South and to the West Side at Hudson Yards. And we think the reason that the traditional Midtown is getting a lot of activity right now is because people are worried about health security, and they only want to ride one train. They don't want to get off, the commuter rail and then get on a New York subway. So that's interesting. That's a health security factor. I think tenants will be much more conscious of things like air volumes in the buildings. So what is your recharge rate? How much fresh air is coming into the building? We are now ranking and getting certified, not only with LEED certifications, but also with Fitwell certifications. So our building's healthy. And I think that is something that we promote, we're promoting a lot more heavily with customers. So I think health security will be important. And then there's a different topic, but I do think sustainability is also getting more important. So being the Salesforce organization, you can see the tower here behind my shoulder, they promote the sustainability characteristics of that building more than we do. It's LEED Platinum, there's a water refreshment system in that property, and they're promoting it not only to the community, but also to their employees. So I think these are some of the new things I think we're going to see post-pandemic.
Yeah, I think that some of this, it's interesting. I think some health security measures will stick and others will not. I mean, we put out, pretty significant health security protocol around cleaning and air quality and physical distancing and screening and things like this. And, I think the air quality and the filtration and the cleaning are probably going to be things that stick around for us. But you wonder whether, the temperature screening that we're doing, or, even some companies talking about vaccinating people that are in the buildings or doing testing for people that are in the buildings. You wonder whether that stuff's going to continue, or even some of all the signage around, distancing. So it's going to be interesting to watch how that changes. Yeah, I would say.
Yeah, I think some of those measures will go away, Mike. I think the temperature is going to go away pretty quickly, and I think I think there won't be as much spacing, and certainly by the end of the year in the elevators and in the lobbies. But people may be much more reluctant to get on that crowded elevator, and they'll wait for the next one. It'll be interesting to watch the behavior.
Yep. So another kind of important trend in office space over the last few years has been the growth of co-working. And, co-working was one of the biggest absorbers of space in our markets. And I know even in Denver, the last time I was in Denver last year, there was a big empty WeWork being developed in Cherry Creek. I don't know if they ever occupied it or not. But, these clients are now in contraction mode. We've seen some bankruptcies. What do you think happens with this industry? And what do you think of the need for flexible space offerings in the future?
I think co-working has a bright future, but it's got a very difficult path over the next year or two. And what I mean by that is if you look at co-working customers, there's basically three types. There's individuals, small business, and large business. And individuals like the product, it keeps them connected and in the workforce. Small businesses, which we serve with our own Flex by BXP product, love it because it's easy. One thing that co-working forced us to do was to be more nimble and easier to deal with in terms of vending our space. And what I mean by that is, if you're a small customer, you hired a broker, you toured some space, then you had to hire an architect, you had to build it out, you did a 50-page lease, you had to get a lawyer. I mean, it was complicated. It took a lot of time. Now, with Flex by BXP, you just say how many seats you want to fill, and we can, if we have a unit, we can give it to you tomorrow. And you just move in and you pay for it by the seat. And so, we've done a better job of making our product easy for someone to acquire. And then I've had, in terms of large business, I've met with heads of real estate at big companies, named companies that say, look, we're not going to, put all our people into a co-working space, but the needs of our business change faster than the real estate industry's ability to deliver space. So if we could procure 1, 2, 5, 6% of our space on a flexible basis, we would pay a big premium for that. So I think the product is here to stay. Now the issue is the pandemic. What a horrible environment for co-working, because the key to the business is density. It's sold not by the square foot, but by the seat. And so putting more people into less square feet is the key to the business model. And the pandemic, is you need the reverse. So I think there's going to be a huge shakeout. Many of the companies that are in the business, or if they're leasing space, not just doing fee jobs, they're going to get shaken out. I do think WeWork has a strong ability to survive through this because of their backing from SoftBank, and there's a lot of speculation now about them doing a merger with a SPAC. So who knows? But given they have 50% market share, they're the name brand in the business. I think they've got a good shot at getting through this. I think you're going to see probably a couple of operators make it through this. And I think you're going to see the landlords take this up more. You know, if people like Boston Properties are going to say, look, you know, we need a co-working installation at the Embarcadero Center. And because we want to have that product available at Embarcadero. And we're going to say, look, we'll just, you know, we'll build it out and we'll manage it. So I think you're going to see a lot more landlord offerings too going forward.
Yeah, I think what we found is a lot of these companies that we put in Flex, they didn't really care about having the barista or, you know, the free beer or the weekend trips that were being offered by community managers. They wanted flexibility and ease of access to space. They wanted the friction taken away. And they didn't know whether they were going to be in business in 2 years or triple the size in 2 years. So they certainly didn't want to commit to building out and creating new space themselves. So I felt like we had a lot of success with that. And it's a good incubator potentially. And it's also a good thing to do with expansion space, you know, where you have buildings where you have expansion floors for people. Building it out in that way is, I think, you know, a good way to go.
Yeah, that's a good point. You know, if you have as an office landlord, you rarely have any kind of pricing power because of your market share, but sometimes you have that on a micro basis, you know, in a particular complex or a particular location. And one of the things that's really valuable is, you know, you have the ability to move tenants around. So if you need to create a bigger space for somebody and you own, you know, several million square feet in buildings that are all around, you can move people around and accommodate certain tenants. And so I do think having a flexible offering as part of these larger complexes makes a huge amount of sense. You know, it's like an apartment complex. You don't build an apartment complex with all 1 bedrooms. You know, you have studios, 1, 2, 3 bedrooms, and same thing with Flex. It's just another offering. You know, we have multiple floor offerings. Well, we don't like to have those available, but when we do, you know, we try to do long, you know, corporate leases on those, and then sometimes we'll build out suites and lease those on a 3 to 5 year basis. And then I think there are other customers that just want more flexibility. So you're just adding another product to try to move space in a particular location.
Mm-hmm. So I want to shift to the capital markets a little bit. You know, transactional activity in 2020 was down, obviously, because of COVID. Risk tolerance, you know, was down a little bit. You know, what trends are going on in the investment market for office buildings? What are you seeing? How do you think that's going to change coming out of the pandemic?
Yeah. Well, you know, the truth of it is that if there's any distress in office real estate, it's in the public market. It's not in the private market. And when I say distress, I don't mean distress in the sense of, you know, there's lenders that are forcing sales. It's just, you know, where assets are trading. So if you look at, you know, even our stock, our look-through cap rate, you know, it's come up a little bit with this recirculation that's gone on in the public market over the last couple of weeks to the reopening stocks. We've benefited from that. But our look-through cap rate today is probably mid to high 5%, I believe, Mike, today. So, but if you look at the underlying buildings, you know, there's billions of dollars of office buildings that are trading every quarter in the 4 to 5% cap rates. And even though volumes are down, you know, volumes were up like 70% from the 3rd to the 4th quarter of 2020. And I think there's a lot of transactions in the market right now. I think the big difference is the following: the deals that are trading have limited lease rollover. That's I always say WALT is king, weighted average lease term. So because right now the office markets, there's not much leasing going on. It's difficult to determine where rents are. So buyers, you know, there's a much bigger bid and ask spread on buildings that have a lot of near-term lease rollover because the sellers, you know, have more aggressive assumptions than the buyers do. But buildings that have a long weighted average lease term are going for pre-COVID cap rates. And the reason is that the sellers are happy because they're not taking a discount because of COVID, and the buyers feel like they're getting a discount because their financing costs are lower. So that's where the market is. So we've seen, you know, big buildings in Seattle and New York and, you know, San Francisco, all of our major cities selling, but they all have long weighted average lease terms. And then if you have a building with rollover, you are going to get discounted for that because of where the leasing market is. And those owners generally are saying, look, I'm not prepared to take a COVID discount because I can easily refinance. There's a lot of liquidity in the market. As you know, the Fed and Treasury have been pumping a lot of liquidity into the capital markets generally. And those owners can more readily refinance and hold on. So you're not seeing as much selling going on for buildings with lots of rollover.
Okay. How about markets? I think there's a couple of questions that had about the markets, and we're pretty picky about selection of markets. We've stuck with our coastal kind of big city gateway markets. We've looked at some of the other markets that are hot and trendy, but we really haven't moved into them. What's our driver around market selection?
Yeah. No, it's a good question. Mike and I are always getting asked, why aren't you in Denver or in Austin or South Florida? All these companies are moving there, and why don't you guys build some buildings there? So this is a way we think about it. We build, but we hold. A lot of developers are merchant, meaning, they build and they sell when they make their profit and they sell the building. So if you're a holder, you need rents to go up. And for rents to go up, you need two things. You need demand and you need barriers to entry. So we have decided that the gateway markets of this country, DC, New York, Boston, San Francisco, LA, we're trying to get into Seattle. We think they have strong growth, maybe on a percent basis, not as strong as say in Austin, Texas, or Denver, but they do have growth drivers. And second, it's hard to build things. It's expensive. It's hard to get entitlements. There are laws in some of the cities like San Francisco that preclude development, and it allows rents to go up over time and us to create value as a holder. So that's why we've stayed focused on that group of cities. I think if we were to move to a higher growth city where there are less barriers to entry, we would have to adopt a more merchant approach to what we do, which is build and sell.
Yep, I think the other thing that's that's important to us is scale. The way we operate is we don't go in and go buy one or two buildings. The advantage that we want to have is to be able to build a platform so that we can actually develop and lease and manage these properties on site ourselves and get an economy of scale where we can stretch that platform. And some of these other cities, including Denver, historically have been a little on the smaller side for us. I think Denver, although I would love to come back here, and it's performed really well in the last cycle because there's been so much job growth here. And if you look at rental rate growth, it's been above average, and there's been a lot of tech jobs that have been added, and that's something that our company has shifted towards, is going to places where there's tech jobs because that's where all the job growth is. I think it's been harder for us to make a move like coming to Denver because of the size. And Denver's kind of interesting because it's got a bunch of different commercial nodes. So I think you have to be even smarter to be successful in Denver because there's all these different commercial nodes. You got to make sure you're in the right one. And some of the traditional downtown towers really haven't competed as well. But we have looked at it a little bit. So we're running a little light on time. I've got a couple more questions, but I thought, we could get some questions. I think there might be some. And I don't know, Mike, if you want to ask a couple of these or ask some yourself. We're happy to stay on for a few more minutes and answer any questions that anybody has.
We got Mike, a few Cavaliers in the chat. That's good.
There you go. Hey, no, we're actually monitoring some of the questions from the chat. The questions came up with the, everything that's going on with COVID recently. Have you guys, or are you planning on changing your strategic focus from development to buying at this point?
As I mentioned in my comments, we haven't seen a whole lot of buying opportunities. We don't generally buy things that are fully leased at a 4 cap. We're a property company and a builder, and we want to buy things that we can make better. We do a renovation, we do releasing, and we create value at the property level. So I think there'll be some of that this downturn. I'd be surprised, but I think our focus is going to continue to be development. One pivot that we are definitely making is doing a lot more life science work. You know, that has been one sector that we cover that has been hot and probably gotten hotter during the pandemic. 45% of all the lab space in the country is in the Boston area and in San Francisco, and we're the largest office landlord in both those cities. And fortunately, we own buildings that we can convert, and we own sites that are in attractive life science locations. So we are probably launching right now $500 million plus of life science new development and conversions, which is, I think, going to be a very attractive investment area for us for the next several years.
You know, and I think on the acquisition side, this is very different from in other recessions.
Yeah.
Every other recession, there's been distress in office, job loss, and opportunity for us to acquire assets. So, you know, between 2011 and 2014, we bought $5 billion worth of real estate, and it was on sale. So we did very well. We're not seeing that. As I said, you know, office using jobs have not been lost. So there's not distress for us to, you know, try to be acquisitive into. So it's going to be interesting to see if it happens as we kind of go through the next year or two. But right now, it's hard to find.
You bet. And then going back to the central question as far as the future of office, for those leases that you have signed up and gotten people to release at this point, have you seen changes in the tenants programming at all as far as what they're actually putting in their space?
You know, not much. You know, we have a great window on this. Diane Hoskins is the chairman and co-CEO of Gensler, and she's on our board. And Gensler, as you may know, is the largest grossing architecture firm in the world. And they do base building work, but they're real, they built the company doing interiors. And, you know, she has a great window on all this, and we spent a lot of time getting her input, and she hasn't seen a lot of changes. I mean, clearly CEOs and leaders are trying to figure out this hybrid work model and what that means in terms of space change. But, you know, Mike talked about the Verizon deal that we're doing in Boston. You know, they leased 400,000 feet from us and started their build out right at the beginning of the pandemic, and they've just continued with their current program. So we just haven't, I mean, it's surprising to me a little bit. I would have thought we would see more change, but so far we haven't seen much.
You bet. Well, just because of time constraint, I have to say just thank you at this point, Mike, Owen. Sincerely appreciate your insightful discussion today on the future of office. And for everyone else, for the time being, I have a few final announcements to provide. I would once again like to thank our sponsors for today's program, including the Bascom Group, Conscience Bay, DPC, East West Partners, Goldberg Properties, Coble and Company, the Nicholas Partnership, Otten Johnson, Robinson Neff and Raganetti, W.W. Reynolds, and W.E. O'Neill. Your dollars do make a difference, and thank you. Thanks also to our community partners who helped get the word out about this year's virtual forum, including Crew Denver, Demcar and ULI, and our media partners, Colorado Real Estate Journal and Business Den. Finally, thank you to everybody, the attendees, for your support of the CU students and your time and attendance today. It's very important for the entire CU Real Estate Center, and we thank you for all your time today and work. The platform at this point will remain open if you care to network with other attendees. A reminder, if you're networking with students later, that will open momentarily. Use the login and link that you got from Katie. Last thing, Katie reminded me, if you have any internships or potential job opportunities, please contact her. We're here for the students. We're seeing what we can do for the students, and thank you. One last note, please mark your calendars for the next CU Real Estate Forum, which will be our 25th anniversary. and that's on March 9th, 2022, and it will be in person. So see you there. Thank you.
Thank you, everyone.
Thank you.
Thank you, everyone. For those of you who are still on the call, if you are interested, we have opened up some breakout rooms again. At the bottom of your screen, you should hopefully see a little icon that says breakout room. And if you do, you can click on that and join any of the rooms open to network with fellow attendees and sponsors. If you do not see that option, please let me know, and I'm more than happy to manually put you in a room. This is Megan Mahar speaking, so feel free to send a message in the chat if you do not have the option to join a breakout room and you'd like to, and we will make sure and get you in there.